What's up with you?
Get ready, get ready. I was in the shower when you called, trying to get out here.
Right, or lowercase a, Dion.
Huh?
Dion is your back.
Yeah.
Okay.
I give it to you already,
Yeah,
right?
yeah. Okay.
Good morning, everyone. Hello, good morning.
Morning.
Can everybody hear me well enough?
Good morning.
Yes, we can. It's much
Good
better
morning.
than
Yes.
last week.
Wonderful, wonderful. Well, I hope you guys are ready for a few hours of this and that. If you've done any reading at all, you probably figured out that chapter 2 has a whole lot of new and interesting stuff. That's the chapter we'll be talking about today. It's really a whole lot of important discussion about the fundamentals of bookkeeping, which leads to good accounting practices. So you might say it forms a great deal of the ABCs of accounting and bookkeeping. So you certainly want to pay attention to these concepts that are coming up in chapter 2. Uh, if you're not a bookkeeper or accountant, it's okay. The principles are still important to know uh, in other aspects of your life. So welcome aboard with all this madness again today. Any questions that you might have lingering before we begin from last week? Okay, I hope you guys have had a chance to look at the facts of chapter 1 again from our last discussion. Today we'll finish off the financial statements that we didn't get to in last week's discussion, and then we'll jump right into chapter 2 because we have a lot of little bits and pieces to deal with today. But first things first, let me see who is with us so far this morning. Augustine, Natasha, are you there?
Morning.
Wonderful. Good morning. Okay. By the way, does everybody know which week we're in already?
The third week.
Yeah, the third week already. And even though we have 14 weeks, as you can see, the week's already beginning to make its way. So please try to stay on top of your reading. Don't get stuck trying to catch up with 2 and 3 chapters just before exams and all that crazy stuff. It will drive you nuts. Okay? So in between lunch hours, when you don't have anything to do on the weekend and all that stuff, you get up in the middle of the night, can't sleep because you're thinking about debits and credits, just pick up your book and read a little bit, stuff like that. All right. Owen, are you there?
I'm here.
Way to go, Owen. You're still with us.
Yep.
Wonderful. Ashley. Okay.
Good morning.
Good morning, Ashley. How are you?
I'm good. How are you?
What can I say? Trying to keep up with you young whippersnappers. Okay, welcome aboard again. Who's this? Akaria.
Hello?
Hi, Akaria. Are you there?
I'm there. Curious here.
Wonderful. Crystal, are you there? I don't think so. The other thing you probably will notice eventually, accounting, just like the alphabet, is a building blocks thing. These are the fundamental things, and as you go through to the end and up to your midterm exam, you'll find that concepts and information builds one thing on the other thing. And even when you get to the other part of this semester, you'll find that new concepts like assets and liabilities and shareholders equity accounts and all that stuff has its building blocks in these very same fundamentals that we're doing now. Okay, so the better you learn how debits and credits work, how transactions are recorded and connect to each other, the more you'll understand and be able to manage the concepts that are coming later. Okay, that's really the key. All right. Samantha, are you there?
I'm here, present.
Okay, presente. Okay. Fabienne? La Rochelle? Where's Fabienne today? Okay. Shadell? Cheryl? Is that a yes, Cheryl? Okay. Ivannette?
I'm here.
Okay, weren't you here last week, Ivannette?
Yes, I was.
Wonderful. For some reason, I didn't have a tick test. Good thing. Okay, let me put that in. All right. Cheryl Miller-Bow. Haven't heard from Cheryl yet. Shadell. Okay. Rochelle Roberts.
Hi.
Okay, Rochelle, were you here last week?
Yeah, I was there.
Were you here the first week?
Yes. So
My, Rochelle. It's a good thing. Let me just mark you on my thing as being here. I don't know why. Okay, great stuff. Nothing from Shadell yet. I haven't heard from Cheryl yet. Okay, Michelle, are you there? Roca?
Yes, I am. Good morning.
Okay, wonderful, wonderful. Any relation to Loftus Roca, the late, great Loftus Roca?
Cousin.
And it's a small world indeed. Okay. Donna Stubbs. Sorry, Dion.
Good morning, present.
Good morning, Dion. Okay. Wonderful. Indira.
I'm here.
Okay, Indira. Did anybody have any issues with downloading material? I'm the only one. Indira.
I can't help you.
I understand completely because I'll tell you, that's okay. That's why I called your name because it's not really that simple. Because of the drop.
Maybe one of the maybe someone on the talk can assist you. Someone did it for me.
Yeah,
I don't know how to get it on the computer.
yeah, I quite understand. Trust me. I was messing around with trying to get on the computer, and my phone started screaming, looking at me funny, giving me, if you don't stop this nonsense, I'll turn off, or something like that. In other words, it just didn't work for some reason. Uh, but it worked. It came up on the phone. The only problem is the phone is too small. Like getting it to the computer is the problem. Yes?
you can try downloading WhatsApp for desktop and open the link in the WhatsApp on your computer.
Stop the madness. We even
Oh
have
yeah,
a
that
stop
works.
on WhatsApp.
Mr. Wilkinson, what you can do is that you can take the PDF document and email it to yourself and then open it as an attachment.
Email it to myself.
Yes.
Didn't work for
I,
me. That didn't work for me because it was too big.
You have to do it.
That started to work until it got to page something of 1,000. Then it starts acting funny, wouldn't move. So maybe, probably too big.
But the books are at the school now, so
They are.
yeah.
I wish somebody would send me an email. Okay, so that's the other option. Luckily for me today, I realized that the information in chapter 2 from 11E is very very much the same as the textbook. So for today's class, I can get away with that. It appears. Um, does everybody have a text now?
Yes, I got my text. This is Cheryl. Perhaps you
Oh,
can
yeah,
be
Cheryl.
present. I'm a bit late.
Okay, yeah, I need to Cheryl. Oh, yes. Let me just mark you here. Okay. So you have your text. Does everybody else have a text? Yeah.
I don't have my taxes yet. I'm using a PDF on my laptop.
Okay. So as soon as you get the opportunity, if you have an alternative source, that's fine. As long as you can get to the reading, that's the first and most important thing. The other thing is, as soon as you can get a textbook, go down there and get one, not only for the class session, but also to keep it as a source of reference, just in case you need to check something out. Okay. Uh, it's it's a good idea to certainly have, especially in accounting tax for such as this for the fundamentals. Right? That's the key. All right, and then last but not least, Melissa. Hmm, Melissa is not here. All right, so welcome aboard, everybody. Let's get right into this today's stuff. We have a lot of little bits and pieces, especially for the first timers in accounting, to a lot of information to try to digest. Please, as we go, if you have any questions along the way, you don't have to wait until after the class next week or some other crazy time. You can raise your questions anytime. Okay, feel free to do it. Interrupt me at any time. All right, please. Um, did I tell you when you will be having your midterm exam?
Week 7,
Week 7, yes. Which date is that? Anybody? Which
April 10th,
date? Sorry?
April 10th.
April 10th. Are we agreed on that? April the 10th. Okay. So Saturday, April the 10th, that's our 7th week. You will be having your first exam, which will be your midterm. And the plan is for us to have covered at least 5 chapters, maybe 6, but at least 5. Wherever we end at the end of week 5, that will be the material that you will be responsible for your midterm exam. I'm trying to find out if your exam is going to be, probably it's going to be an online exam. Okay, it won't be an open book, so you will not be allowed to open your textbook and just try to find stuff. At this stage of the game, we want you to suffer through the traditional examination for accounting purposes so that this stuff can stay in your soul forever. All right, so start reading up and practicing your journal entries and transactions and all that stuff early so that when examination time comes, you won't be like, man, what's an income statement? I should have looked at that earlier. Things like that. What the hell? Cash flow statement? Man, I don't remember doing that. You don't want to be in any of those situations because you would have been on top of your game. That's the key. All right. So April 10th is our tentative date for our midterm exam. If something extraordinary happens to cause that to be different, I will certainly let you know ahead of time, but you can start your preparation in relation to that date. Okay? Also, sometime this weekend, I'm going to send you a little assignment um, based on what we've done last week and today so that you can practice some of this stuff that you're learning because I'll tell you, accounting is 90% practice and the other stuff is conceptual, which you remember in theory. The more you practice these certain things, the better you will be at understanding them. So I'll be sending you an assignment. You can call it a homework assignment, and of course, it's designed for you to sit down and actually do some mechanics, which is very important in accounting. also to doing it and understanding it, and also where I want you to get stuck in certain areas, so when we come back, you can say, well, I got stuck somewhere, and then we can have a discussion about those things to further clarify this information, and that's how you get better at doing this stuff. There's no magic potion, I'm afraid. You just have to do, talk, investigate, ask, and get on somebody's nerve, and don't worry about it. Just do it. And you'll be fine. Certainly will not get on my nerves. Please don't think that you could ever ask me too many questions. You cannot. It's very hard to get on my nerves. You have to really, I can't think of anything at the moment. All right. So, and of course, I will give you, um, for those who do submit the work, I'm not going to sit down and grade every single piece of stuff you did for homework, but I'll certainly give you feedback, and I certainly expect feedback. And I will give you, out of the additional credits that are available, I'll give you credits for doing the work, for attempting to do it and sending it in. If you don't send it in, I'll just go to your 10% or something and take off one of the 10 or some stuff like that, just to encourage you to actually sit down and mess with this stuff. Okay? Because I know a lot of things are competing for your time. All right. Any questions before we move forward? Okay, great. So, do I need to share the rest of last week's screen for anybody's purposes? Or everybody can see those financial statements at the end of chapter 1? Everybody can see those financial statements for the Vice Consultancy Inc. Hello? Testing, testing. Is anybody there?
Yes, we are. I'm thinking that everyone has
We're
the
here.
statements.
I'm just checking to see if everybody can see the financial statements at the end of chapter 1, the Vice Consultancy Inc. Or do I need to share the screen?
I think you should share the screen.
Because I don't see anything for the Advice Consultancy Inc. that you're speaking about.
Fascinating. Amazing that that text does not have that. Okay, let me see if I can share the screen then. Okay, great. It's right there. Can you see that?
Yes.
Yes.
Yeah.
Okay.
So I don't think that's at the end though.
It's not at the end.
No.
What a disservice in that particular edition. I'm surprised. Well, you remember last week we looked at this statement, the income statement. Everybody remember that?
There.
Yes.
Okay. And we said that after looking at consulting fees for the month and taking out the expenses, what 3 categories of expenses do you see?
The rental expense, the wage, and the utilities.
Yes, rental, wages, and utilities. And these are the different classifications of expenses. We'll talk about classifications very soon in chapter 2. The revenues for this company were how much for the month?
14,000.
14,000.
Yeah. And the total expenses for the company?
5,600.
Yes, indeed. Which means that income before taxes ended up being
8,400.
8,400. Did this guy pay any taxes to the government?
1,200.
Yeah, $1,200 he paid to the government. Can anybody use that math, that arithmetic they learned in grade 6 to tell me what percentage of 80 of the income that 1,200 represents? What percentage of the net income does the 1,200 represent? This is the analytical side of accounting that you'll learn as well going down the road. Just getting your feet wet a little bit. What percentage is the income tax of net income? Anyone? Anyone has a percentage? Just in case I didn't mention it before, remember you need your calculators for every accounting class. And your examinations, by the way.
Are we speaking about the ratio formula?
Yes, we talk exactly. We're talking about the ratio. What is the ratio of income tax expenses to net income? What percentage wise? How do you calculate that?
The net income divided by the average total assets?
Oh, I- well, yes, that's correct for another kind of ratio. But for this particular one, we use a similar calculation. We just use different classifications to do it. For example, since we know the net income is 8,400, and we know that the income taxes um, represents $1,200, then if we take $1,200 and divide it by 8,400, what do we get?
Seven?
14%.
What percentage?
14.2%.
14.28.
Yeah, 14 to 15% if you're rounding it up or down. All right.
Yes.
So in other words, on that income, the company is paying 14 to 15% tax rate to the government. Do you follow that, folks? And therefore, that $1,200 has to be subtracted from the net income of this company in order for the company to come up with its net income after taxes. What is the net income after taxes in this example?
7,200.
Absolutely. All right. So now we're just being introduced to what an income statement looks like, and some of the important components of the income statement. Again, you have for each individual, you have to go over this as many times as is necessary for you. Some people look at it once and it's a piece of cake. They remember what all these elements mean. Other people might look at it the third time and like, what the hell? Why am I not getting it yet? Don't worry about it. Look at it a fourth time. That's the whole idea. Everybody's different. The key is that you look at it until you kind of understand it. And in due season, it'll come. Okay. So those are the components of the income statement. And therefore, if I give you an assignment and ask you to prepare the income statement, the assignment will have all the data that you need. All you need to do is find the information that you need to construct this income statement. And that's pretty much what's going to be part of your initial assignment. So you can get some practice and physically doing this stuff. Because this is like going to the gym. If you say you want to go to the gym, watching it on TV is not going to help. You're not going to lose any weight. You have to actually go to the gym and exercise. And accounting is like that. You can read it, talk about it, sleep on the book or whatever. But until you start practicing some of this stuff, you're like, oh man. So even if you're not doing my assignments, if you come to the end of a chapter, pick one or two of the major concepts, practice them on your own for your own edification. And if you get stuck, bring it to the class and help your colleagues. Like, man, I did this thing and I didn't understand what this concept mean in this practice question. Don't be afraid to do that on your own initiative, okay? By all means. And that's separate and apart from any assignment I might give you. Okay? All right, so the other statement. Did we have a statement before the income statement? Anybody remember from last week? Did we have a statement before the income statement? No, we just said, if you can see this, that there are four primary statements. We started with the income statement. Then we're gonna look at the retained earnings statement. Then we're gonna look at the balance sheet, and then finally the statement of cash flows before we move into chapter 2. All right, so let's do that.
Question, Mr. Wilkinson.
Yes,
Would this statement be the same as the statement of owner's equity,
which one of them?
the one that we're doing now? Because the
The
four
statement of
statements that
retained
they,
earnings?
yes.
That's an excellent question. It would not be the same as, but it is a part of the statement of owner's equity. All right, and you'll see how it's connected to the statement of owner's equity very soon. Okay, but that's an excellent question.
Why
Retained
did they
earnings
say
is a
is?
part of the statement of owner's equity, but it
Okay,
is not the statement of owner's equity.
okay, because the book
Okay.
doesn't, the new
The
book
book
doesn't have retained earnings. That's what I'm
Yeah,
asking.
yeah, that's the hell, you know. Uh, I'm beginning to think we should have stuck with the bloody 11th edition because it gives you this kind of stuff early. Anyway, that's unfortunate because this has been such an important part of introducing students to statements at the beginning. All right, so this statement of retained earnings then, if you look at it, by definition, retained earnings is simply this. Let's say the company, how much did the company make in profits after taxes this month, the one we looked at? Anybody remember? Was it 48? The one we just looked at, the income statement.
previous one.
Yes.
7,200.
7,200.
Yeah, 7,200. So let's say every month for 1 year, the company makes 7,200 in income. That means at the end of the year, how much income would the company's made?
Say it, Michelle.
7,200 for each month. How much is that in 1 year?
That'll be $86,400.
Indeed. Now, I just kind of put you through that exercise because I want you to, start banging on your calculators just for the hell of it, because you will be using it a little bit. So that's the annual revenue. But we're looking at the consultancy company on a monthly basis. So let's keep it consistent. Remember, one of the principles of accounting, consistency. Whatever we do last year, we need to do this year, and next year, and the next year, and the next year, unless something extraordinary happens. And if it does, the management has to give a good reason to change the program, not just because they feel like it. Right? Very important principle. It's called the principle of consistency. Right? Okay. So in this statement of retained earnings, then, how much? First of all, retained earnings is simply this: it's the company keeping all of the profits it makes inside the company. Does that make sense, everybody? In other words, whenever a company retains earnings, all of the income, net income that they make, they keep it in the company. They don't pay any dividends. Now, if I say things like they don't pay any dividends and you're not clear on that, just say, what the hell you mean by dividends or something? But if you know what dividends are, fine. All right. So if the company keeps all of its net income, we call that retained earnings. Okay. So at the beginning of December, how much was in the company in retained earnings in this example?
$0.
$0, which seems to suggest that this statement represents Weiss's first month of business, correct? So if this is his statement for the first month at the beginning of his company or the company, there's no profit because none has been made yet. So at the beginning, December 1st, there's 0 retained earnings. Then for the month of December, how much net income was earned?
7,200.
Yep, 7,200. And then we are told that he took out some money for dividends. in the first month, how much did he take out?
2,400.
2,400. And therefore, the retained earnings that was left at the end of the month was
4,800.
4,800. And so basically, what the retained earnings statement does is this. It shows all the net income that is kept inside the company minus any dividends that are paid outside the company. And then after dividends are paid, whatever is left becomes retained earnings for the new period or the new year. Okay? And it's as simple as that. It's a very simple statement, but it's a very important statement because certain people looking at the company's performance may want to know, for example, were any dividends paid? And in this example, said, yeah, 2,400 bucks. To who? To the shareholders or owners of the company. Fine. They're entitled to dividends. Right? Or the dividends paid may have been zero. So you might look at that and say, oh, no dividends paid. Everything is kept in the company so the company can have the money to expand its business. Okay? Because the assumption we make in accounting is that all income that is retained or kept in the company is going to be used for the further development and expansion of the company. You don't want to pay all out in dividends, and that way you start running short on cash to do other things for the business. Okay? But certainly the dividends from time to time have to be paid to the owners of the company to compensate them for investing in the company. Okay? Again, if I use any language that you're not clear on, just interrupt me and say, what the hell do you mean by that? All right, don't be afraid to do that. All right, so that's your statement of retained earnings. It's very simple. And not to worry if you're not 100% on it, you'll get a chance to practice it either on your own or by an assignment that I will give you. All right, and then of course, the third statement is the balance sheet for the company. Notice the balance sheet has three major elements that we saw earlier. Does anybody remember what the accounting equation is?
A equals L plus C.
Indeed. What does A mean?
Assets equals liabilities plus capital.
Indeed. Uh, it's easy to tell when you're really beginning to understand stuff when you start breaking it down to A equals L plus S or E. That's what I'm talking about. Okay? That means you're kind of getting a handle on what this stuff means. All right. So if you look in the balance sheet is also comprised of those same three elements. Do you see them? Do you see the three elements of the accounting equation in the balance sheet?
Yes.
Okay. What do we have in the assets category?
Cash,
Okay.
accounts receivable, supplies, land, building.
Land and buildings. Any other assets?
No, no, that's it.
No, no other assets. What do they total?
207,200.
$200.
Indeed. Any liabilities for this company? Do they owe anybody money? A liability is what you owe.
Yes,
How much does this company owe?
2,400.
2,400. Of course, from the balance sheet, we can't tell who they owe the money to because that information is not reflected in the balance sheet. That information is reflected in subsidiary accounts that you'll learn later, which shows the details of transactions for each person that you owe or who owes you, which we call accounts receivable. Okay? The balance sheet doesn't get into that detail because the balance sheet's job is to simply summarize each account total, not to show the details. They are shown elsewhere in the accounting records. Okay? So this company owes $2,400, which is fantastic because that means this company is not heavily in debt. Does everybody see that?
Yes.
A lot of companies drown just like a lot of people because they're too heavily in debt. And after a while, they don't have enough income to pay their bills. And therefore, when you drive past downtown or somewhere, you see the companies close its doors. A lot of that is because there are too many liabilities. They owe too many people, including banks. And if business declines, like during the pandemic or otherwise, and revenue stops coming in, that company is going to be in trouble. Same thing applies with individuals. If you overborrow as an individual, you have too many loans. If you lose your job, you'll be in trouble. Even if you have a job, if something happens, you have a difficulty paying those loans back. And then all of a sudden, everybody is calling you and you're thinking about suicide because you can't take it anymore. Okay? So maintaining and controlling liabilities is a very important part of doing business, either personally or economically out there, and something to keep in mind. All right, so we know the total assets are 2072 and the liabilities are only $2,400. Which means that based on the accounting equation, everything else has to be sitting in which account? Based on the accounting equation, the rest of the resources have to be sitting in which account in the accounting equation?
Capital, stockholders equity.
Capital.
Stockholders equity.
Yeah, in the capital or stockholders equity account. All right. Let me just say capital account and stockholders equity account are the same. The reason why we use them differently, and you'll see later, capital accounts are usually is the term that we usually refer to sole proprietorships and partnerships. Okay. When it comes down to incorporated companies, we refer to the equity account as stockholders equity. Okay? Something to keep in mind. All right. Now, notice the stockholders equity account is divided into two categories. The first category is
The common stock.
the common stock, and the second category is
Retained earnings.
that retained earnings account familiar to anyone?
Yes.
Yes, we saw that earlier. Why is it 4,800 and not 7,200? Say it again. Why is it 4,800 and not 7,200?
Because that's the amount what's left after they took the dividends out.
Thank you very much. God, this stuff is beginning to kick already. That's the amount that is left after the dividends are paid. Okay. If no dividends were paid out of this company, that amount would have been to $7,200. And please keep that in mind as you go forward. Okay. Now, does everybody know what common stock is?
What?
What is common stock?
No idea.
Okay. Well, if you go to J.S. Johnson or Cable Bahamas to buy shares from them or Finco, let's say you get a bonus from work and you decide to invest $5,000 in Finco shares or Cable Bahamas shares, because now you want to become an investor and you want to invest some money for the long term so they can start paying you dividends. See that word again? And so you take your bonus for $5,000 and you go to Cable Bahamas and look, I'd like to buy some of your stock. And Cable Bahamas says, great, we can give you 500 shares of stock for $5,000. Okay? That $5,000, along with other people's 5,000, 10,000, 20,000, 30,000, whatever they buy shares from in the company, is what we call common stock. Common stock represents the ownership of the company by the persons who bought shares into the company. And what it means is every time you buy shares in a company, you become a part owner of that company. The company adds up all the shares that it sells to the outside public, and they call that common stock. Okay? So this $200,000 represents the investment in the company by the shareholders who purchase shares in this consultancy firm. Everybody get that? Does that make sense to everybody?
Yes.
Okay. If it doesn't, please raise a question. Don't be stuck. All
You
right?
said that it's an investment to the company
Yeah,
by stockholders.
indeed. The common stock is the investment that persons outside the company make in the company. So every time you buy shares from a company, the company will take your money and give you shares. And the shares they give you, in this case, total $200,000. So this 200,000 represents the investment in this consultancy company by individuals outside the company who have purchased shares. Okay? So let that roll around a little bit. If you need to raise a question about common stock later, please do. Okay? But you'll see more of that later on, which will make it even clearer to those who might still be a little in the dark. All right. So in this example, the stockholders' equity of this company is made up of two components: common stock, which is the investment by outsiders, and retained earnings, which is the net profit that is kept in the company after a month of business in December. So the total stockholders' equity then becomes
204,800.
absolutely. Now, based on the accounting equation that you should know by now, the liabilities plus the stockholders' equity on any balance sheet should be equal to what?
Assets.
Total assets. Absolutely. So if you follow the rules, that's the other thing. Once you learn the rules of accounting, they hardly ever change. The only thing that changes are people misinterpreting and egging up the rules. Once you stick to the rules, things will work out in accounting just about every single time. If things don't work out in accounting, you have done something wrong, which includes violating some rule or principle. It's quite as simple as that. So according to the accounting equation, the total of liabilities and stockholders' equity should equal how much?
207,200.
Does it in fact equal that if you add
Yes,
it together?
yes, it does.
Indeed. I encourage you when you're reading text and looking at these things, even though the text has the numbers, still add them up yourself. They might have a typo every now and then, might be wrong. Okay, but it's nice practice just to get into a groove of doing it. See, do. I always tell my students accounting is like kissing. If you wish to kiss but never kiss, you'll never know how to kiss. Like that. You have to actually kiss to know how to kiss. Okay? Remember that. Well, you gotta put it in. Okay? But it's kind of, I know it's a strange example, but I use that one so you can remember. All right. So that's your balance sheet. So now we've done 3 statements so far. Trust me, you will see more statements and they'll be more complicated than these. That's why we start with little itsy bitsy baby steps. So when you get to the other ones, you're like, man, this is hell, but at least I get it somewhat. And then eventually you get it. There's no magic, no miracles, no speaking in tongues to get the answer, none of that, which is okay otherwise, but not for this. You have to actually do it. Okay? I know I said that before. I'll say it a few times along the way. All right, so what 3 statements have we looked at so far?
Income statement, retained earnings, and balance sheet.
Indeed. And that means we have one more statement, which is this statement, the cash flow statement. All right. Now, the cash flow statement in accounting is simply money, cash coming in and cash going out. This is usually the statements that students tend to have the most trouble with. And even in practice in the real world, some accountants sometimes run into trouble, especially if they're not preparing them on a frequent basis. So I say that simply to say, if you don't get it all in one gulp, don't panic. It's not the end of the world. It'll come together. This is not the last cash flow statement you'll see. Okay. So let's go through it just so that you can become familiar with the expressions. Okay. Remember, I also told you last week or the first week that any financial statement that you prepare for me, for your exam, and in the real world, if you get to do them or participate in doing it, there are three things that must be at the top of your financial statement at all times. What are they?
Name of the company,
The name of the company,
Yes,
name of the
type,
state,
the type of statement, and the
name, type
date.
of statement, and the date.
date.
Now, let me say, in the real world, if you don't do that, it's going to come into question and have to be fixed and corrected. In my examination, if you don't do that, you will lose 3 easy points. Because I tend to give 1 point for each of those 3 for students who just remember to do it. And I do that because it's so important. Okay? And it must be in that order. Please don't put the statement name first and then the name of the company second. Please don't put the period at the top and the statement at the bottom and the company in the middle. Accountants don't work helter-skelter. Remember, we are a conservative group, and once we set things in motion, we don't like people and situations that come in to try and change our consistency. And we do things on a consistent basis for a reason, so that there's no helter-skelter stuff going on. You don't do what you feel. One day you get up, I feel like putting the name third. Next day you get up, I feel like putting in the middle because I just feel it. Doesn't work that way in accounting. Okay? Just thought I'd throw that out. All right. So let's begin. Let me say, first of all, that the statement of cash flows has 3 major components. The first one is cash flows from operating activities, cash flows from investing activities, and going further down, cash flows from financing activities. All right. So in addition to the heading of the statement, the next thing you want to be aware of are those 3 components. Okay? Now, let's look at the first one, cash flow from operating activities. Notice the first item is net income. Does everybody see that?
Yes.
Yes, the 7,200. Where did that come from?
The income statement.
The income statement.
Yeah, the income statement. And notice I ask you certain questions because accounting is all about connecting the dots and analyzing situations and transactions before we get into preparing statements and preparing transactions and so on. Okay? It's very important to be able to analyze and understand what's going on and how things are connected. Okay? And this is why I ask you certain questions. Okay? To see if you're beginning to connect the dots. All right, so net income is the first item, 7,200. And then we have some adjustments that we need to make in order to reconcile what we call net income to cash position. Don't worry if that doesn't make sense yet, it will. Okay? All we're doing now is looking at the basic mechanics of the statement of cash flows. Later on, we'll see it actually, how it's actually done in detail, and it'll be a lot more clarity. Okay? So for now, the first adjustment to net income is what we call an increase in accounts receivable. Now, first of all, does everybody know what an accounts receivable is?
Funds that are owed to the company.
Yes, money that is owed to the company, simple as that. And in this case, we are told that the accounts receivable account for the month increased by $4,000. Now, that means that you sold $4,000 worth of goods on credit again this month, which increased your receivables by $4,000. Now, this bracket in the cash flow statement means that whenever you increase accounts receivable, what you are doing is actually creating an outflow of cash, not physical cash, but in practice, you are creating an outflow of cash. What does that mean? It simply means that whenever you give credit to your customers, what you are doing is denying yourself the receipt of cash. Does everybody understand that? Is that true?
Yes.
Yes. And so whenever you deny yourself the receipt of cash as a company, what you're doing is creating an outflow because you're allowing your customers to keep the money until later. So that's money going out for you, technically, even though you didn't pay it out. Does everybody see that?
Yes.
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 No.
No? All right. If 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 you owe me $500 and you pay me the 500, did I get the money? Physically? If you owe
If
me
you,
$500 and you pay me, do I get the money?
yes,
Yes. But let's say you owe me $500. So that's an inflow for me because I got the money, correct?
yes,
Okay. But let's say you owe me $500 and instead of paying me, you come for another 500. That
Okay.
means that I haven't received the first 500 and I'm allowing myself to give you another 500. So I'm increasing the receivable that you owe me, correct?
right. So the receivable will be increased by what, 1,000?
But yes, which means that that's $1,000 going out. I didn't pay it out, but it's going out because you haven't paid me. It's out there still because you haven't paid me. Does that make sense?
Yes.
Yes. And the reason why a lot of people lose money and have to close down their business, don't have any money in the bank, because they don't really get that. They don't really always realize that every time you give credit, you're extending the amount of money that is out there because you're selling goods and services on credit. And every time you increase your receivable, that's money going out for you because you're not getting anything.
So accounts receivable is just a fancy word for credit.
Well, it's a fancy word that says you expect to be paid when you give credit. How's that?
Okay.
Yes.
Okay.
Okay. We create that account because you don't get cash. So, and since you don't get cash, we need an account to account for the fact that you are not getting cash. And so the account we use to account for that is accounts receivable for two reasons: to show that you have money out there and to show who owes you money. So you can eventually run them down and get it, or if necessary, sue them to get it. But the point is, every time you give credit and your accounts receivable increases, that's an outflow for you because you're not getting any money. That's the point you need to see. That's why it's in brackets. Okay, folks?
Mhm.
All right. So in this case, when accounts receivable increases, that's an outflow. So brackets represent money going out of the company. All right. Now let's say that there's a decrease in accounts receivable. What is that? Inflow, outflow?
Inflow.
Yeah. When your accounts receivable goes down, that means somebody's done what?
Paid you monies.
Pay that debt.
Yes, it's not complicated. Only the initial impact of it is complicated. See? But once you start messing with it and understanding it, or learning how it works, that's the key. Learning how it works. Then, as you can see, it's not difficult. And it's an important concept to know, especially if you own a business. Okay? So if you're owner of a company on the side or full time or whatever, and every month you pick up your bloody statement, this one, or the balance sheet, and every month you pick it up, you see accounts receivable going up and up and up. Should that concern you?
Yep.
You better let it concern you, or else you won't be in business for too long. Because if your people don't pay you back, where are you going to get the money from to pay your salaries? BPL, water and sewage, Steve McKinney for advertisement, or whatever it is. Car insurance, gas bill, this thing. Where are you going to get the money if people are not paying you? That's why when you get credit from people, they call you morning, noon, and night. Like, where's my fucking money? And you think they're being mean. Sometimes they're mean, but they're not just being mean for the hell of it sometimes. They're like that because they need their money back. Do you follow that, folks?
Yes.
So when you owe, now you know why it's important for you to pay. Because if people owe you, you don't want them every time you call and say, I ain't got it. I'll tell you when I have it. And all that stuff. They don't want to hear that. because they have bills to pay too. That's why they want those receivables paid. That's why they want those receivables paid. Because every time those receivables go up, that means that you get to keep the money and they don't. So that's an outflow for them. Soon the company won't be able to pay its own bills. It's an interesting thing. Let me just say for the record, for those of you guys who just doing this theoretically, many companies have drowned because their receivables were too high and they didn't have a mechanism in place to collect it effectively. Okay? All right, so we'll leave that for the moment. So any increase in receivables means cash flow outside or bracket, and any decrease means an inflow or no bracket.
I don't think so. I think he's smarter than that. But if he isn't, maybe he's the one who should consider keeping his thoughts to himself. Thanks for having spent part of your morning with us. For all of us here at Outside Lines, I'm Jeremy Sheff. Stay tuned now for Sports.
I'm sorry, I'm hearing somebody's newscast. Okay. All right. Still hearing the newscast. Okay. So what is the second element then under cash flows from operating activity? What is the second element?
Increase in supplies.
Yes, increase in supplies means that you bought some stuff to increase your supplies, whatever they are. And since you bought some stuff, it's an outflow and the brackets are there. Remember, brackets mean money going out or cash out. Okay. So if you increase supplies, you had to buy them to increase it. So that's an outflow of $2,000. The third component is increase in accounts payable. Is that an inflow or outflow? Increase in accounts payable. What is accounts payable?
Money being paid out. Company owes.
Yeah, money that the company owes. So in this case, the company's accounts payable has gone up by $2,400. Why do you think there are no brackets there if the company owes this money?
Because it's considered cash in.
It is considered cash in, and the reason why it is considered cash in is because whenever you don't pay what you owe, that means you get to keep the money that you don't pay. Does everybody get that? So
Yes, perfectly.
Yeah, Census Company has liabilities of $2,400, which are not paid. The money is where? In the company's bank account. So that's an inflow. Does everybody get that?
Yeah.
Yeah.
Yes.
So if you owe your aunties or your mommy or somebody money, like $300 that you borrowed since forever, just know that that is an inflow for you because every time you don't pay them, you get to keep it, correct?
Yes.
Which is why people don't like to pay their bills because they want to keep it. All right. It's beginning to, and, and companies are that way too. That's why when you do work for a company or the company owes you money and you call them for payment, they try to avoid paying it. Next week, I put it in the mail because the company is trying to hold your money because as long as they hold your money, that's inflow for them because they get to keep it. The minute they pay you, they have to pay that out. Okay. So I have a couple of clients who I do work for, consultancy work. Man, whenever they don't want to pay for some reason, have some other stuff going on, it's hard getting money from them. Okay. And so whenever their payables increase, it's an inflow for them. But what is it for me? It's an outflow for me because every time they don't pay me, it's still out there. So they benefit by not paying me. Does everybody see that?
Yeah.
Very important for the cash flow statement, but very important for you individually and anybody who might be business minded. See, that's why this cash flow statement is so critical because it tells the accountant what's really going on. See, the income statement and balance sheet just gives you an overview. Okay, like it's like the outside of a person, like really looking cool, dressed up, look great outside. But you don't really find out what's really going on in the company until you get into the heart of the person, which is this bloody cash flow statement. Because this is the thing that tells you what's really going on. Notice when you looked at that balance sheet, you only saw accounts payable. It didn't say anything positive or negative. Now, when you look at the cash flow statement, you say, oh, payables have increased. So that means my company hasn't paid its bill. So yay, we still have the money. But the person we owe don't have it, like, ooh, I still owe them. Does everybody get it? Okay. So once we assess those three components, then we come up with net cash flows from operating activities. And we simply take everything that's in bracket and subtract everything that's not in bracket, and we come up with a figure. When we take everything is in bracket and subtract everything that's not in brackets, what do we come up with?
3,600.
Yes, bracket, which means that that amount has to be subtracted from which means that that amount is to be subtracted from in order
Net
to
income.
from what?
Operating activity.
Which is, what's the total?
7, you mean from the 7,200?
Absolutely. So when we subtract the 3,600 from the 7,200, our net cash from operating activities become what?
3,600.
In other words, the income statement only shows 7,200, but the 7,200 is not all cash. Does everybody get that now? What part of the 7,200 is cash?
3,600.
Absolutely. Now that can only mean this stuff is slowly but surely seeping in. Yes, that's important to know. If you look at the income statement and nothing else, you will say, yay, 7,200 in sales, net income. And that's good. But you also need to know out of that 7,200 in net income, only 3,600 represents cash. The rest is out there to be collected or to be paid, meaning that accounts receivable and accounts payables are in there impacting that 7,200. All right. If you don't monitor those things, you will soon have very little cash to operate from. Okay, folks, welcome to the cash flow statement. It is the statement that goes into the heart of the company to tell users exactly what's really going on. And so if you are a banker and your company, this company comes in for a loan, they only want to show their income statement and balance sheet, you could accept them, that's important. But if you really want to know what's going on in the company, you better ask them for this cash flow statement. Okay. I heard somebody moving stuff around. Somebody moving stuff around. Whatever's moving.
Okay, Mr. Wilkinson, I can hardly hear you.
Do you hear the other noise in the background?
Yeah.
Yeah, they need to mute their mics.
Yeah, that might help. Because I can hardly hear me either. Okay. Okay. All right. So the net cash flows from operating activity after adjusting for receivables, supplies, and payables is $3,600. Then we have cash flows from investments. I think we all understand investments mean whenever we spend money to get something in return. Has anybody in this group made any investments before COVID? No? All right. What is an investment? Somebody's still moving stuff, like it's really they're busy moving stuff. The rovers in the background. It's like they're cleaning up something while the mic is open.
Maybe everyone should stay muted until they're speaking.
Okay. Okie dokie. All right. Yeah, that helps. The only problem with that is it takes away spontaneity. It's interesting for every advantage, there's a disadvantage. Being able to keep our mics open means you don't have to press the thing to speak first, but keeping it open means we have to like monitor what's going on in the background. Okay, so what is an investment, anyone? What is an investment? Nobody's made an investment ever?
Yes, I would say that an investment is funds that you loan to somebody to either
To get a return on your money?
Okay, yes. Everything is correct about that except the word loan. Usually, well, sometimes you could lend in a certain kind of investment, like if you are purchasing bonds, that's an investment. You're lending money to the company, they pay you interest, and then they pay you the face value of the bond. But that's for later. But for the moment, yes, for the most part, that is correct. Whenever you spend money for an activity that's going to produce some kind of return for you, that's called an investment, okay, in financial terms. For example, if you open up a fixed deposit, that's an investment. Why?
You gain interest.
Hopefully. The only problem is these days, interest is practically nothing unless you go to a credit union, okay? I went to Commonwealth Bank the other day and I looked up at the interest board and they said all savings and fixed deposit accounts are between 0% and 0.25. In other words, you can't even get 1% on your fixed deposit these days. That's not good. That's not a good return on your investment. But when things are good and things are normal and you open a fixed deposit, you expect to get interest on it, okay? No matter how much it is. When you purchase land, is that an investment?
Yes.
Yeah.
Why?
It's a long-term investment.
Yeah,
Because
Because the
asking for the
value
increase.
continues to grow.
yeah, the value of land increases over time. So if you pay 50,000 for it today, in 5 to 10 years, it will be worth more than 50,000. Did you know that?
Yeah.
And the
In
increase,
addition to the equity that you put into it, that's even more.
of course. So we call it an investment because when we buy it, it increases in value. That's really what investments are. It's something that you spend money for and you expect it to increase in value. If it doesn't increase in value or pay you a return, it's a bad investment. You shouldn't do it. That's why you don't get married to a junkie. That's a bad investment. That's why
Oh, wow.
you don't get married to like women beaters because that's a bad investment no matter how rich they are. After enough beatings, you have to run or you'll be killed. See my point? That's how I know it's crazy. I'm just saying so you can remember. But investments are whatever we put into something, we expect a return. Okay? Uh and that's why when folks are getting like chicks are fighting about their husbands and stuff, they're like, don't you try it. I've invested my whole youth in you, kind of thing. So I'll and whatever you do, you shouldn't do it, even though you have a point, and vice versa, of course. Okay? All right. So I hope I made that bit of investment thing so that when we get to cash flows or investing activity, this company invested in two things. Can you see from this statement now?
Land and building.
Land and building.
Building.
How much did it pay for land?
40,000.
40,000.
And for the building?
100,000.
100,000.
And what do brackets mean? What do brackets mean?
Bracket means
Cash
money
flowing
going out.
Going
Cash
out.
going out. If there are no brackets, what does that mean?
Cash coming in.
Okay, see, the rules are the rules. Isn't it wonderful? Once you learn the rules, you don't have to digress at all. Just keep following them. Brackets always mean out in this case. No brackets always mean in this case. So once the rules are established, that's it. So how much was paid out in total? Investments?
140.
140,000.
Yeah, so net cash flows from investing activity is 140,000 in cash. Okay. And then the final category of the cash flow statement is cash flows from financing activity. Financing, if you don't know, means borrowing. Okay. Now, interestingly enough, in this example, the first borrowing item is the investment by stockholders. For how much?
200,000.
200,000.
Where did you see that before?
The capital in the man, the one before this.
Okay, way to go. And the one before this is called? I like that. And you don't remember?
Balance sheet. Balance sheet.
Yeah, the balance sheet. And what part of the balance sheet is this 200,000?
Owner's equity.
Indeed. And what side of the accounting equation is the owner's equity account?
The right side.
Okie dokie. Can't say I'm not trying to find other innovative ways to get you to remember this crazy stuff. That's the whole idea. The more you mess with it, see, that's why you have to be working it, talking the language. All right? Okay. Who's the guy in the group again? Let me see.
Owen.
Owen. Are you there, Owen?
I'm here now.
Okay. Are you married, Owen?
No, I'm not married.
Oh, darn it. Then a word to the wise is sufficient. You see, you see how this, you see how we keep talking about these different things in the statement of cash flows. The more you talk about it, the more understandable it is. The less you talk about it, the more gray it is. It's like that. When you get married, you have to keep yapping about stuff, so to speak. Okay? And then your wife's gonna say, Owen, when was the last time you said you loved me? He said, man, I tell you that Christmas. He said, Christmas? Man, you need to tell me again. He said, why? I do love you. Can't you see what I'm doing stuff? See, I don't care about your stuff. You need to say it. And it's the same thing in accounting. You have to say it, talk about it, deal with it. And the more you mess with that, the more familiar you become with it, and the easier it comes to understand over time. Sorry, lo siento in Espanol. There is no magic. Okay. All right. So my big question is, how is it that investment by stockholders falls under financing or borrowing? Anybody knows? Probably not. Here's what happens. When you go to buy shares in Cable Bahamas, you become a stockholder, correct? Correct?
Yes.
Yes.
Yeah, because you own 500 shares. So when they have shareholders meeting, even though you only own 500, doesn't matter if there are a million outstanding. You own 500, so you're part owner. So what do? Go to the shareholders meeting with your microphones and make noise, right? Like, get those rates down. They're too high. See, like that. You could go in the shareholders meeting with your 500 shares and make noise. Do you understand how this thing works, folks? A lot of people don't really understand. Even they have shares and don't even know what their rights are as shareholders. All they're waiting for is one little dividend check coming in the mail. Oh, mother's sick. $73, I can do something with it. But in terms of shareholder rights, folks don't even have any idea of what rights they have as shareholders. So the reason why it's under financing or borrowing for this company is when you buy shares from a company, they're borrowing your money for the long term. And we call that shareholdings. So everybody who purchased shares in this company, they're helping to finance the company, because what does the company do with the money when you buy shares? They put the money in their bank account and use it to expand, buy more machinery, buy more equipment, move into new locations, and so on. Do you follow that, folks?
Yes.
Yeah, that's why when companies want to borrow money, they put it onto the market, say we're selling shares.
Mm.
And because they're borrowing your money when you buy shares, they borrow it to expand and do things, and you become an owner as a result. That's why it's under financing. So, how much was financed by this company in terms of issuing shares?
200,000.
$200,000.
200,000.
Also under financing are dividends. Stop it! Some of the birds are tweeting. Okie dokie. Dividends also fall under financing. And the reason for that is when the company has to pay dividends to shareholders, which in this case is how much?
2,400.
2,400. It means that that represents a financing charge for the company because when banks pay you interest on your fixed deposit, that's an expense for the bank. Did you know that?
Yeah.
Did you know that? Yeah, that's why they don't want to pay you any big time interest because it costs them money to pay you interest, in case you didn't know. Even though they're making big time money on the loans from 6%, 8%.
Highway robbery.
You took the words right off my bloody tongue. It's highway flicking robbery, and anybody can quote it. I don't care. My children are grown up. I don't care anymore. It is highway
That's
robbery.
robbing us left, right, and center.
Blind, robbing us naked. See, naked, and it's unabridged, naked, freaking. My God, how the hell you could be given loans for 6, 8, 10, 15%, and paying people less than 1% on their deposit, for God's sake, and then still running them down with loan payment, or we got to sell your house and car and all that's man. I'm sorry, you wouldn't think I was a banker by profession as well. I wasn't only an accountant in my lifetime. I spent 10 years in domestic banking as a credit officer, no less, credit manager, doing all kinds of loans, mortgages, commercial loans, consumer loans, and every loan type of loan you could think of. And then the other part of my banking life was in private banking, all over the place with Tom, Dick, and Harry Bank. So, doesn't matter though, doesn't change what is right. And, anyway, sorry, before I have an unexpected heart attack, it's a bloody, okay. All right, where was I? Dividends. I just put it that way so you guys could remember you youngsters need to do something. Get out there and protest. So why are the banks getting away with it? That's the other thing. How the hell? Sorry. Okay, dividends. So dividends represents what the bank, the company is paying you for holding its shares. Just like when they pay interest on a fixed deposit, dividends is paying you for holding the company shares as an incentive for you to keep those company shares and not get rid of them, to hang on to them. Because remember, when you buy shares in the company, you provide money to the company, that money goes in the company's bank account and they use it to do whatever the company wants to do. Okay? So 200,000 is borrowed, so that's money coming in. 2,400 is paid in dividends, so that's money going out. So the net cash flow from financing activities equals
197,600.
Absolutely. Remember, the more you talk about it, this stuff is the language of accounting, just we have the language of everything. The more you talk about it, the more familiar you become. The less you talk about it, the more foreign it becomes. That's why if you're in a relationship, you stop talking, you start growing apart. See? The same bloody principle. Accounting is like that. You don't want to talk about accounting stuff, you start losing sight of what it is. And so you won't even remember. That's why people start growing apart and say, who the hell are you? And who the hell are you? Because you're not talking like in accounting. All right. So we now have cash flows from operating activities net 3,600, cash flows from investing outflow 140,000, and cash flows from financing or borrowing inflow of 197.6. So the net increase or decrease in cash is
61,200.
how did we get that? I know we have it there. How did we get it? Always ask yourself, how did the book get it when you're studying and reading? Don't take it for granted because you're going to be stuck in an exam later. Ask yourself, how did we get it, and try and find out.
We got it from the net of operating activities, investing activities, and financing activities.
Okay, how did we add them up? Start at the top.
The net for operating activities, that's cash coming in.
Okay.
The net of investing activities, that's cash coming out.
Yes.
And then the net for financing activities, that's cash coming in.
Indeed. So we add all the cash coming in and subtract what? All the cash going out.
Cash going out.
And it should give you $61,200. Okay. And if you don't know that, come test time, you're going to be stuck. I know it's there because you can see it. I see it. It's 61.2. But if you don't actually do it to see how it's done, you're going to be messing with what to do with those brackets and non-brackets. Then you're going to be stuck. I've seen it happen to students all the time for some reason. Even though we did brackets in grade 7, we forget that crap. Okay. All right. So we know that the net increase in cash is 6,200. And was there any cash at the beginning of the month?
No.
No, no cash at the beginning of the month. Because remember, this is a new company just started. All right. And so if there's no cash at the beginning of the month, zero is a number. We subtract that from the 61,002. So cash at the end of the month becomes? Cash at the end of the month?
61,200.
Okay. Okie dokie. So that's the cash flow statement. I suggest sometime before the weekend is over, just to make sure it doesn't leave your mind completely. You go over it again, ask yourself the questions that we talked about, make sure you understand the brackets, non-brackets, what increase in accounts receivable mean, what decrease in accounts, increase in accounts payable, things like that. Remember that investments are what you spend to get a return, and financing is what is borrowed by the company. And also to remind yourself why investment by stockholders represents financing. Because when you buy shares in a company, you get shares or ownership in the company gets your money, that money goes in the bank, and they pay you dividends for investing in that company. That's how it works in principle. Of course, there's a whole lot of other crap behind that, but that will come in due season. Okay? That's the thing about education. It's not an overnight affair, as you know. All right. Okay, are we done with statements?
Mr. Wilkinson, before you go on, right? I'm just trying to tie back that 61,000.
Right.
Looking at the cash flow.
Yes.
I'm trying to look at the breakdown of that, what sums to 61,200.
Okay. I'm so happy that you mentioned it at this stage of the game, because sometimes students get stuck as well, and they don't say anything like this anyway. I'll see it later, and then later it gets worse. Okay, so great point. If you go back up to cash flows from operating activities, after we make all the adjustments from net income, notice we have net cash flows from operating activities of 3,600. Do you see that?
Yes.
Okay, that 3,600 without brackets means money in or out?
Money's out.
Aha, I was hoping you could say that so I could say no. Without brackets means money in. Okay, whenever you don't see brackets, it means money coming into the company. Okay, make a note of that. So that 3,600 has no brackets, and it represents cash coming into the company. Now, do you know how we got the 3,600 that's coming into the company?
Yes, because we have the account receivable and the increase in supplies purchase.
Yes. And there's a
And
third
the
thing.
increase in accounts payable. So we have monies that we what is owed.
Yeah, money outstanding, yes.
Yes.
So when we take the 4,000 that's outstanding, that's paid out, that's outstanding, the 2,000 increase in brackets that went out, and the 2,400 that comes in because we didn't pay our own bill, so we keep the money. When we take the out of all the brackets which went out, and those that don't have bracket, which is 2,400, the net effect is 3,600 outflow. Do you see that?
Yes, I do.
Yeah, and when we take that 3,600 outflow from the income of 7,200, then we have a net cash flow from operations of 3,600 net inflow because there are no brackets. The 7,200 inflow is higher than the 3,600 brackets, so it's a net inflow. Okay? Now, once we get there, then we know that we paid how much for our investments.
140,000.
In or out? Is that money in or out? What do brackets mean?
That is
Going out.
That went out.
Money went out. Whenever you invest in something, you have to spend money. So it's always going to be bracket. You follow? When you make an investment, you have to spend money first, and then you get your returns later. You get your interest on fixed deposit and your dividends later, but you have to put money up front. Okay? All right. So in terms of investments, we paid 140,000 that went out. And then the third category is what money we borrowed. Well, we borrowed 200,000 from the investors who purchased our shares, and we paid $2,400 in dividends. So the net effect is taking what we paid from what we got in, and that resulted in 197,600. Okay. So if we add then the 3,600 without brackets, the 197,600 without brackets, and then we subtract the 140,000 that represents outflow in bracket, then we get the 61,200. Do you see that?
yes.
Yeah. All right. And it's important to actually physically do it in your calculator so that you can actually see it at work other than just on the paper. Okay. So make sure in your calculator, the numbers that don't have brackets represent pluses, and the numbers that have brackets represent minuses. And if you keep it that way, it will not confuse you. Now or test time or any other time. All right. So those are our 4 key statements. The most important one being the cash flow statement, generally guarded as the most important one because it goes into the nitty gritty and the nuts and bolts of what's really going on. The retained earnings statement, as you can see, is just a nice little flow of information. It's great, but it doesn't give any details. The balance sheet gives more information. That's great too, but only tells us what the assets and liabilities and equity are. And the income statement only tells us what we earn in revenue and we paid in expenses. It doesn't go into the same detail as cash flow. And of course, remember there's an expression, cash is. I'm the only one who knows that expression.
Cash is king.
Cash is king. Okay. And of course, accountants have a little dry accounting joke that says cash is king, but the queen spends it. Anybody heard that? No? Okay. All right. So any questions then about any of those 4 statements? Don't worry if it all doesn't stick. Of course, you're going to go back and look at them.
Okay.
encourage
So
you-
I have a question. Does it matter which statement comes first?
Certainly.
That's a good question. Yes is the short answer. It does matter in terms of what we accountants call the proper flow of information. So generally we start off with the income statement, and then from the income statement we prepare the retained earnings statement, because in the retained earnings statement we have income statement information like net income and dividend payments. And then we prepare the balance sheet, which shows the assets, liabilities, and equity as at a particular date. Okay, remember, the income statement shows buying and selling and expenses paid over a period, which is usually 1 year. The balance sheet shows the financial position as at the end of the year, like what is the balance in each account at the end of the year, accounting year or period. And then, of course, the retained earnings statement would follow the income statement, so it becomes a part of the income statement just before the balance sheet. And then the last statement we prepare is the cash flow statement, because the cash flow statement uses a lot of the information from the other three statements in order to dig into what really happened. So that would be the general order, if you're interested in the order of them. Okay? Income statement, retained earnings, balance sheet, cash flow statement. It's best to do it in that order so that you can see the flow. And that I think that discussion comes up a little bit in chapter 2 as well. Okay. All right.
Another question, Mr. Wilkinson. So the
Yes.
cash flow is a yearly statement?
Yes. Now you can prepare the cash flow monthly if you want. If you have a big company and lots of things going on and management wants to know what's going on cash wise, because millions and millions of dollars are spent every month, then the management might require it every month. It can be done every month. Generally, though, it's done once a year. And it's done primarily for the board purposes and senior management and for auditors who are coming in to conduct audit so that they can see where management spent money and where management received money and tie it back into the account to make sure that everything goes where it should go and nobody stole any money in the process through some hanky-panky accounting practice. You follow? But generally, it's once a year. Could be done monthly, could be done quarterly, could be done twice a year. Generally, it's encouraged to be done at least once a year in preparation for the audit as well. Okay? Good question. But don't let anybody tell you that's the only time you can do it. That's hogwash. You can prepare a financial statement daily if you want to. And if you have the proper financial system in place, you can get information on anything in accounting daily, even though we don't necessarily review stuff daily unless we're looking at something specific. Okay. Generally, management wants to see monthly reports, quarterly reports, sometimes semi-annually, every time annually. Okay. And particularly the auditors annually. Okay. So the monthly, quarterly, semi-annual reports are internal for management to use and review, make decisions. The annual report is for management and board as well, but also for the external auditors and the government and shareholders and other persons outside the company. Okay? All right. So I hope we know now that GAAP means generally accepted accounting principles, everyone. If not, that's what GAAP is. You should have read it in chapter 1. You'll probably see it in chapter 2 and maybe again. Generally accepted accounting principles, which are what we call the conventions or rules and procedures in accounting. Part of GAAP is heading up financial statements, the way I told you, those 3 steps in that order. That's part of an accounting convention. It's done that way every time, every time, every time. Okay? You'll be learning more GAAP rules later to help you to understand how accounting is done and why it should be done in a certain way every single time. Cannot be changing it up whenever you feel like it. Any company that starts doing that, auditors and other people start to get suspicious. Why are you doing it? Because sometimes the board and top senior management start changing stuff because they're up to no good. And it's a signal to the auditors and others who know what's going on that maybe somebody's up to no good, because they're trying to keep changing the accounting conventions for no good business reason. But then that's for those of us who are way up there in accounting messing with this stuff, doing the analytical side of things down the road. There are all kinds of other issues that come up. But now, just know that generally accepted accounting principles is what accountants use in order to get their work done. So if I ask you that question as a short answer question or definition in your midterm exam, and I said, what is GAAP or what a GAAP, then you should just give me the conventional definition. GAAP means generally accepted accounting principle, which encompasses the rules and conventions and procedures for accounting practice. That's it. All right. Because that's all you need to know right now. Trust me, all kinds of things are coming. So don't worry if it doesn't kick in yet. All right. Notice of this note at the bottom that I have gaps. Gap are constantly growing, changing, and improving as expected. Okay, and you'll see some of that stuff later on. Gap in the audit. Notice audits are performed in order to ensure that financial statements have been prepared in accordance with GAAP. So when auditors come in, they're not necessarily looking to see if somebody is quote unquote thieving money. But while they're doing the audit using GAAP rules, they might come across the fact that somebody is acting fraudulently. Okay? That is not the primary purpose of the audit, even though many people are saying that ought to be part of the primary purpose. Or originally, conventionally, historically, auditors didn't come in to find out who stole money. But if they did find money missing, they have a duty to say to the management, we believe that there's fraud, theft going on in this organization. But the primary thing that they come in to check is to make sure that financial statements conform to GAAP. Okay? Generally accepted accounting principles. Wherever it doesn't conform to GAAP, the auditors will say to management, these do not conform to GAAP, change them, or we'll have to make a recommendation, or we cannot give you a clean audit. Too many things do not conform to GAAP. It is outside accounting principles. Until you clean them up, we cannot give you a clean audit. Okay? Audits are performed by CPAs who are independent, meaning they should have no relationship with anybody in the company. They shouldn't be married to anybody, friends with anybody, going out to nightclubs with anybody, going out on dates with anybody, none of that stuff. When they come in to do that audit, they're supposed to be completely independent. No personal relationship should be allowed to get in the way of the auditor's work. That's why it's done by somebody outside the company. And even though the company has its own CPAs and other accountants inside, they work for management and they're the ones who could be doing things very right and doing things very wrong. The independent auditor comes in to make sure that things are going according to GAAP. If they're not, then management and its accountants and inside CPAs and other A's are asked to fix it. Otherwise, the auditors will not render an opinion that is favorable for that company. They will say that, in our opinion, the statement presents unfairly and do not conform to GAAP. See, that's third point. So if any of you have seen your auditors come in, that's what they're doing. If you didn't know before, that's what they're doing. So now in the future, when they come in, while other people are wondering what they're doing, you now know what they're doing. They're coming in to see if the accounting people are conforming to GAAP. All right, they are independent of the company. They should not have any personal relationships of any kind. So if the senior partner from the auditing firm on the outside is invited to a helicopter ride to the CEO's doggone private island, he should refuse it. Because chances are they're trying to what? Anyone? Anyone?
Trying to bribe.
Trying to what?
Trying to bribe or something.
Yeah, maybe bribe the auditor or speed the auditor up so that if he finds anything wrong, he'll just tell them and let it go. He wouldn't reveal it to the shareholders or anybody else. Do you follow what I'm saying to you? So if you're an independent auditor and you're doing audits for a particular, any one of your companies, you're not supposed to be involved with anybody in the company. Because there's sometimes senior people in the company like to invite you to fancy restaurants. Oh, it's just having dinner. Private island, chicks in bikini and all that says, oh, just be to relax. But what they're really saying is, if you find anything wrong in my company, I need you to let me know. So if we need to cover up anything, Mr. Auditor, you will remember where I brought you. And we had a great time with some lovely people who were so friendly to all of us. Okay? Like that. Happens all the time. Many auditors find themselves in trouble because they find themselves compromised in the very same way that I'm presenting to you. Okay? So that's kind of what is expected of the auditors. And so when auditors come in, this is why. All right. Organizations that influence generally accepted accounting principles. These are international organizations across the United States and around the world, accounting bodies that monitor GAAP practices in the United States and around the world. The FASB, Financial Accounting Standards Board of the United States, is one of them. International Accounting Standards Board, IASB, that's part of the international accounting community, to try and get into places like China and Russia and in those places to see if we can get them to use more conventional practices rather than their own. Can't trust anything coming out of China, unfortunately. You just can't, whether it's accounting or otherwise. We know it's funny thing, nobody's talking about the virus coming out of China, and then all of a sudden they're the good guys and sending bloody vaccines all over the place. It's another thing. I hope the government of the Bahamas doesn't buy any vaccines from China. I don't have anything against Chinese people as people, but history has shown, right. Is that an accounting issue? It sure is, because they don't conform to GAAP either. In case you didn't know, they have their own accounting practices, and they're not necessarily International Accounting Standards Board practices. The world is trying to get them to conform. They say they are, but who really knows what's going on with them? Imagine what's going on in North Korea. Nobody knows anything about them. I wouldn't talk about accounting practices. So if you're doing business in North Korea, that's an interesting thing to do. Should you be doing business with them at all? And if you're doing business with them, can you trust their financial statements? I don't know. You can't trust anything they're doing because nobody knows what they're doing. That's the whole point of this organizations thing. So this stuff that you're learning the fundamentals, but I can assure you, the fundamentals are only the fundamentals. There are a whole lot of things going on behind the scene. And all these things are interrelated. And if you go far enough in accounting, you'll see more of them. Okay? GASB, Governmental Accounting Standard Boards. In the United States, for example, GASB is a governing body that makes sure that persons who are involved in governmental accounting, that they in fact follow the practices that are set out in the GASB, GASB, General Accounting Standard Board, and not doing their own thing. In the Bahamas, we don't have a written GASB, but we follow, of course, the international UK, US format for government accounting. And of course, our Auditor General of the Bahamas is expected when he goes in to make sure that government departments who are responsible for accounting for government money and spending government money are accounting for them properly. Okay, GASB. Then we have the SEC, the Securities and Exchange Commission, which monitors all investment activities in the United States. In the Bahamas, we have the Securities Commission of the Bahamas, which does the same thing. And again, these are all oversight organizations that influence the behavior of GAAP, any changes in GAAP, making sure that GAAP is consistently applied by organizations who are presenting financial information. Okay, and then last but not least is the PCAOB, the Public Accounting Oversight Board. These guys and girls monitor auditing firms and make sure that auditing firms remain independent and that they are not involved in any activity that can prejudice any audit process and bring disrepute to the auditing profession by becoming compromised and taking bribes and allowing management of firms to sweep them up so that they do not conduct their audits properly. Unfortunately, it's a very common problem. You might not be aware of it because you're not necessarily operating at that level, but it is a huge problem. Okay? So the PCAOB, Public Company Accounting Oversight Board, is again designed to watch the auditors. So the auditors are watching companies and the PCAOB are watching the auditors. I wonder who's going to be watching the PCAOB soon. It's another matter. All right. So those are some of the organizations that impact GAAP in terms of the responsibilities that GAAP has. Okay. Let me say that the accounting profession, like legal profession and medical and all others, have a code of conduct. Okay, the accountant's reputation for independence and competence is critical. When they go in to do audits for a small, medium, or multi-billion-dollar company, they have to exhibit a certain decorum, a certain independence, and a certain level of competence in doing their jobs. Okay? As a result of this, the AICPA, the Association of Independent Certified Public Accountants, they have a set of code of professional conducts and ethics that their CPAs need to follow. If they're found not following them, they will be stripped of their licenses and may or may not get it back to practice accounting publicly again. Public accountants and CPAs, their primary jobs tend to be auditing and dealing with tax issues, but primarily auditing. And they're expected when they come into the firm, as we noted, to be independent, ethical, and competent. Anybody who misses on that deal could find themselves in trouble as far as their license and their reputations are concerned. Okay? Questions that come up under professional conduct are, is the accountant honest and candid about their findings? Does he or she put aside any personal gain in order to do their jobs? Don't take any bribes, don't have any fun with people who you're going to audit. It can influence your decision. Don't go and see any dancing girls if you're a guy. It can influence your decision. So integrity is the key. That's what it's all about. Integrity, honesty. Is the accountant impartial and intellectually honest? Can they make decisions without being influenced by anybody else? And when they find stuff, can they say straight up what it is? Or can they be bribed to shut up? It's another professional conduct issue. Okay? And this is called objectivity. Can they be objective no matter what? Okay? And then finally, does the accountant avoid all relationships that could impair his or her objectivity? Easier said than done. This is the independent side of it. We talked about it. So the three key issues of professional conduct are integrity, objectivity, and independence. If the accountant is not able, the CPA or the public accountant who's coming in to conduct an audit is not able to exhibit those three things on a consistent basis, then we have a problem, Houston. Okay? That auditing firm will be called into account and maybe eventually have in disrepute and reputations tarnished, and in some cases, no longer an auditing firm. That's how serious it is. Okay? So it's not just the work, it's the individual. The individual has to keep themselves free and clear of any influence by anyone within the firm. And any amount of money. My. All right. So there we go. This last point is just an ethics question about Carla McDonald. She's a CPA working in audit with Trevor Industries. Teresa Wong, the staff accountant at Trevor Industries, invites Carla, friendly invite. Carla, not Miss McDonald, Carla. Okay, all kinds of things go on. Invites her and her audit team to dinner at a very expensive restaurant. And she wouldn't even allow the team to pay their own bill. She says, I'll pay the check. And the question is, if Carla allows Teresa to pick up the check, has she violated any ethical standard? What would you say, Con? Right off the top of your head.
I would say yes.
Why would you say yes? I agree with you. I would say yes.
Well,
Why would you say yes?
this, now the accountant. I think my mic. Oh. Go ahead. Hello?
Right.
Okay, yes, I would say, yes, because it could be considered what word I want to use?
Make up a word. Yeah, bride, dog.
Yeah,
Yeah, an old-fashioned bride.
yeah, and
And
McDonald might kind of feel obligated,
yes,
maybe, to do certain things.
of course, this is nothing new.
Mhm.
We'd be discussing it in an accounting context, but it's not only accounting and auditing. This crap goes on even in church. Even church people are bribing each other, are they not? Amen. This is
Oh,
not just
God.
this is not just an auditing problem. No, hell no. Doctors are bribing each other, lawyers are bribing each other, doggone it, accountants, church people, Bishop Tingham, the deaconess system. Man, this is everywhere. Professional conduct, this is not an accounting issue. This applies everywhere. Husbands and wives even bribing each other. Did you know that? Maybe if I do this, I can get it.
Yes.
Maybe if I do that, you'll be bribing. Okay. Sometimes even now, after all these decades, when my wife says something, I'm like, okay, what does that mean now, sweetheart? She's like, what do you mean? I said, I mean what I mean. Are you trying to bribe me? She says, not really. I'm like, okay. So yes, uh, this is very real stuff. And if in this case, in the world of accounting, we expect it to be independent. Notice this discussion on ethics does not say that Carla and her team cannot go to an expensive restaurant with Miss Wong. Do you follow? It didn't say you can't. The problem is what?
Or paying the bill.
Yes. So really what Carla should do is yeah, let's go. We could talk informally about this bloody audit. But we are paying the bill, see? And then put it on the auditing company's check. Don't let the company pay. Because once the company pays, dog eats your lunch. What the hell? The biggest truck ever is passing during my lecture. Apparently you didn't get the email. Did you guys hear that?
It sure did.
Okay.
Well,
Okay.
I guess it'll be the same as my neighbor who didn't get, she's mowing her lawn.
No, didn't get an email. All right. So there you have it. The ethical point here is not going to dinner with her from the company, but rather letting the company pick up the tab. That's why even in your normal day to day, if somebody keeps offering to pay stuff for you, it may mean nothing. But depending on who keeps offering, every time you go out together, says, I'll take the tab. Don't worry. And the time you say, oh, God is good, or whatever. And maybe he is, because I don't get in God's stuff. Hell no. But certainly, sometimes it's not always God at work. Sometimes people are doing their own work for some reason. Or like my grandma used to say, ordinata. Anybody knows what ordinata means? No?
No.
My. We're losing everything. Ordinata is an old time expression in the Bahamas for all the other. All right? So just in case you hear grandma say ordinata, now you know what she means. But nowadays, grandmas are so young, she's not saying ordinata anymore. She doesn't even know what ordinata is either. True? No answer. Is that an accounting issue? I don't know. Okay. Everything is an accounting issue. How about that? You may not be able to put everything in debits and credits, but everything needs an accounting perspective, correct? Absolutely. Absolutely. If you haven't seen that yet in this session, then you haven't seen what you need to see yet. And that's okay, because you're not supposed to see all that crap yet. You're just supposed to be messing with the mechanics right now. All right. So having said that, we've beaten that horse to death. I don't think you have any excuse with regards to anything in that chapter. Now we can go forward with confidence. Doggone it. And see what's going on now in chapter 2. Okay. So everybody has their notes, textbooks, all that stuff. Chapter 2, I could just roll on. Okay. Now, chapter 2 talks about analyzing business transactions. Does your text have that little making a statement on the left-hand side? The very beginning of chapter 2? Where you have the income statement, owner's equity. Do you see that? Do you have that?
What is it, Mr.
You said
Wilkinson?
a statement should be on the side.
On the very beginning, of chapter 2, it says analyzing business transactions. Yes.
No.
What does it say?
No.
Yes, yes.
Page
Concepts
40.
underlying business transactions.
Page what?
You don't
40.
see.
Page 40.
40.
40. Concept of underlining business transactions.
So your chapter 2 doesn't begin with analyzing business transactions?
It has
It's just
analyzed
worded differently.
business
Yeah.
transactions. Yeah.
Yeah. It's kind of like the same thing. Do you have a set of statements right on the side showing the connection of the statements?
No, we have like a flow chart.
Yeah.
Economic events, recognition, valuation, classification, business transactions that affect financial position.
Okay, that's a little further down. All right. So let me say at this point in chapter 2 that first of all, somebody raised the question, are these statements connected? And do they flow in a particular fashion? Let me see if I can, I'll just share this. Let me see if I can share this screen so you can see it. Let's see. Yes, let me share this one with you. Can you see that screen?
Yes.
Okay, if
Yeah.
you look to the left-hand side, you'll see. Oh, so you get the, I could scroll up, you could see what I'm doing. That's good. Okay, doggone it, that worked. I was wondering if that would work. All right, so you'll be moving from my screen to your textbook. The information should be basically the same, give or take some changes in wording here and there, but it's pretty much the same information. All right, so somebody asked earlier, what order should the statements be in? Now you can see the order. If you look to the left of my screen, you'll see the income statement. Net income goes down to the owner's equity. Do you see that?
Yes.
Yeah, which goes down to the
Balance sheet and statement of cash flows.
and then the statement of cash flows. So that's essentially how the information flows. Now, somebody may say, well, I don't see the retained earnings statement. In this example, the retained earnings statement is built into the statement of owner's equity under net income, because the retained earnings statement is only an expansion of the net income activity. Okay, so you have net income minus dividends equal ending retained earnings. So it's built into the net income. But essentially, this is how the information flows through the financial statements. Okay. All right. So let's say right off the top, just for information purposes, that all business transactions require the application of 3 accounting concepts. And those 3 concepts are basically recording a transaction at the right time, recording transactions at the right time, putting the correct value on the transaction. Kiss my foot. I know it seems like just at the moment, these are critical. And number 3, calling transactions by the right name. Please make a note of that. Accounting concept required 3 key things: recording transactions at the right time, placing the right value, dollar value on them, and calling things by the right name. If you mess up in any of those 3 areas, your accounting information will be messed up. Okay? And notice the text will tell you that most accounting frauds and mistakes occur because they violate one of these 3 things. Simple as that. So you've learned a whole lot in 1 or 2 sentences. If you do those 3 things right, you'll get most of accounting right. If you violate any one of them, you're going to have fraud and errors all through your accounting records, whether you know it or not. A lot of companies have been stolen from, they don't even know that they've been robbed because they missed it. Sometimes auditors catch it, sometimes internal audit catch it, sometimes external auditors catch it, sometimes a staff member catches it, whatever, but you don't catch all. Okay? And basically it's because those 3 things are not being done properly. All right? All right. So let's go down then to the measurement issues. Do you see that? Is that in your text? Measurement? Three measurement issues are recognition, valuation, and classification. You should have that.
Yes.
Yes. Yes. And I'll tell you a secret you already know. Those who find stuff faster are those who've already read it. Those who've taken a little while are like, man, I haven't read this bloody thing. Like, what's that? Which is part of the advantage of reading ahead. Makes life not perfect, but a little bit easier. All right, so the 3 issues, measurement issues in accounting, have to do with recognition, valuation, and classification. Okay? Under recognition, all right, we have the issue of deciding when business transactions should be reported. It's a big problem. Some people think they know, some people should know, but don't do it right. And some people know and do it right, and some know and still don't do it right for some reason. So this issue of recognition is crucial. When to record a transaction. Every transaction in accounting does not have a recording instance. You need to know that. Because it's a transaction doesn't mean something needs to be recorded. Right? Wow. For example, if you look at under recognition, an employee sends a purchase requisition for the desk to the purchasing, from the desk to the purchasing department. Is there anything there to record?
No.
No. Like, what are you going to debit and credit? Nothing there to record. The purchasing department sent, so don't make up anything. The purchasing department sends a purchase order to the supplier. Anything to record? Anything to record in 2?
No.
What about 6? The company pays the bill.
Yes.
Okay, okay. The company,
Payments made.
yeah, the company receives the bill. Any transaction there?
No.
Maybe no, but not necessarily in this case. And this is what makes accounting interesting. You have to learn what to record and what not to record and why and how. And that's why you don't just jump into bed with accounting and say, oh, 2 nights should be enough. I'm good. No, it doesn't work that way in accounting. It's a process. Because see, number 5, the company receives the bill from the supplier. Well, there may or may not be something to record because when you receive a bill, you have to record that you owe that bill, don't you? Right?
Yes.
Yes.
So now all of a sudden there is something to record. You have to record that you owe that bill. So if you bought a car and you owe $10,000, you have to record that car as an asset because you bought it, but you have to record that bill as a liability because you owe it.
Payables.
Absolutely. So trying to figure out when to record is not always easy, especially if you're new. Experienced people obviously.
If she didn't, I may die.
Sorry? All right, so keep that in mind. So the general guideline then for the flow of information, we are told, starts with an economic event or transaction in the company, recognizing what's to be recorded and what's not to be recorded, coming up with the proper valuation for the transaction or dollar value, and then classifying the transactions properly. Okay, and we'll see that very shortly. All right. All of them lead to business transactions that what affect the financial position of the company. So if you record things,
Mr. Wilkinson,
yes,
you could go back up to the number 2 point
number
where
2,
it said the purchasing department sends a purchase order to the supplier, right?
yes,
If I remember, you said that you don't record that. You don't record that, right?
right.
But I mean, for logistics purposes, that should be recorded.
What would you record?
But I mean, if you're sending a purchase order to the supplier,
Right.
eventually that would turn into a payable. So
Remember,
for logistics purposes, for the logistics manager, that should be recorded, because eventually if that purchase order is fulfilled, it then turns into an invoice. So that's a logistics, for the logistics point of view, it should be recorded.
indeed, and the purchasing manager, whoever, could keep their own records to make sure that they follow up on that purchase order if it's not actually activated. Because remember, a purchase order is just an order to purchase. Nothing has happened yet. It's instruction to carry out an activity. And so, yeah, whoever's responsible for purchase orders will have their file and method of follow-up on the purchase orders that have been issued. However, from an accounting perspective, we have no interest in that until what?
Until it's failed.
Yeah, until something actually
Comes a
happens.
bill.
Yes. So your purchase person, whoever's responsible for that, fine. Even if it's an accounting department for some reason, fine, it's there being monitored, but there's nothing going in the general ledger on that. Nothing is gonna.
We were so you're okay. You just meant in terms of it shouldn't be documented in the general ledger. Okay, I agree. I thought you meant generally.
Oh no.
In general.
Oh hell no. We record everything in general. Not record. We follow and monitor everything in general. Absolutely. But for accounting purposes, there's no recording and posting until something happens.
Okay, thank you.
Good point. Good point. Okay. All right. So all of these, this guideline is really just what accountants and use in order to come up and recognize what needs to be recorded and what does not require any recording. Okay. You guys have this focus on business practice in your text. You should. I'm not going to terrorize you with it, but I encourage you to read it. Sometimes there's always something interesting in there. Then here are some examples further down of economic events from that chart that should and should not be recorded. For example, on the left-hand side, events that are not recorded. We've given some examples so you can understand it a little better. A customer makes an inquiry. There's nothing to record for accounting purposes. See, what we're talking about is for accounting purposes. Accounting purposes. Company hires a new employee. There's nothing to record until you do what? Pay salaries. Okay. Company signs a contract, nothing has happened, nothing to record. These are just day-to-day economic business activity that have no accounting implications yet. On the other hand, whenever a customer buys a service, do we record that? Company pays an employee, do we record that? Do we? Do we record when the company pays an employee for work performed?
Yes, we do.
Yes, we do. What about the third one?
Yes.
Okie dokie. Now notice I'm touching these as we go so that you can be in tune with what's going on. Remember, I may not touch everything because you have to go through. I don't want you to not read what you need to read. I want you to read every single thing. Now you can skip something and I wouldn't know, like he wouldn't see if I skip. And that's true. Okay? But I encourage you not to skip. Right? Because all of these little things, remember I said accounting builds up. Every little thing builds up on the other things like a ladder. And if you meet If you miss any steps in the ladder, you might slip and break your neck. Same thing in accounting. If you decide to miss any steps, you might miss something important. Then come test time or work time, you're like, man, what the hell is that? I didn't hear that in class. I don't remember reading that because you didn't, or you were not at class, one or the other or both. All right. So, what about the valuation? What does that mean? What does valuation mean? Focusing on what?
Putting money,
Yeah,
monetary aspect
attaching
of
a
it.
dollar value to the transaction. That's it. Attaching a dollar value. In accounting, there are two types of value. The cost at the time of the transaction and what we call the fair market value, meaning what appraisers say it's worth. Remember I told you last week, appraisers could say anything, but for accounting purposes, what do we do? Which one do we use? The cost of the transaction at the time it occurs. Remember that? If you buy land for 50,000, it might be worth 100. Accountants don't record the 100. Remember that, or you're going to run into trouble. Accountants only record what?
Cost.
The cost, what you paid for it today. What is worth later is something the accountants deal with later, but that's not what we record today. You paid 50,000, that's what we record. Don't come to the accountant and say, I paid 50,000, but it's worth 100, record it 100. You could say it, but any accountant worth its salt will not do that. But it'll make the balance sheet look better. So GAAP does not require that, and I follow GAAP, not the appraiser, not you, Mr. Manager. Okay, folks? Remember that.
Plan delivery till like 2 o'clock.
That is the essence of valuation. Okay? All right, what about classification? What is that? Anyone? What is classification? Has to do with what?
Assigning each transaction to a category.
What's cash? What accounts receivable? What is common stock? What is dividend show? In other words, accounting has a language for putting transactions in, and if you don't use the language of accounting, the rest of us will not know what you mean, and you will be violating GAAP. If you have a cash transaction, we know it's money, but you can't put money in the balance sheet. You follow, folks? You don't say debit money.
No.
Okay. So that's what we mean by classification. Okay? We have to learn them. And then when the transactions occur, find out which classification best fits what we need. Because we have to use the language of accounting. Because remember, we use consistent language so that every accountant everywhere in the world, when we see it, we all know what it means. We don't want to see no debit yen or debit doggone Indian rupees. Hell no. Cash is cash no matter what language it is. Now we need to calculate an exchange rate to come up with what is value. That's different. But cash is cash everywhere in the world for accounting purposes. That's what we mean by classification. So read those details clearly so that when the time comes to classify transactions, you can learn to do it properly. Okay? All right. My. One of the most important classifications that come up that students get stuck on, even people in practice, is the difference between expense and an asset. Both are debit balances, but they're not the same. Does anybody know the difference between an expense and an asset yet?
Yes. An expense is something you paid for today. An asset is something that you pay for in the future, or something like that.
That's getting warm. That's
Something like
getting
that.
warm. Yeah, that's getting warm. It's
Yeah, I
not.
think that it explained that. It said that. Anyway, yeah.
Go ahead. Tell me what it says. I don't mind if you read it from the text.
I'm not reading. I'm trying to remember what I read.
Even that's fine.
It said that it becomes an asset when when you use it for long term. It gave an example. If you prepay for your rent, it becomes an asset. An
Okay.
expense is something that you pay for. If you pay in a monthly rent, that will become the expense, which you paid for this month. But if you
Indeed.
prepay, that becomes an asset.
Indeed. And we're going to see that very soon. It's interesting you remember that. That's a very important concept in accounting. And it's going to come up very shortly under what we call prepayments. Yes. Okay. It's a whole other thing that students get stuck on, a prepayment thing. But for the moment, an expense is whatever you pay to generate income. Let me make it simple at the moment. In other words, when you're in the business of selling goods and services, you have to pay certain expenses in order to sell goods and services, correct? So in order to sell goods and services, you need staff, correct?
Correct.
So you need to pay salaries expense to generate sales, correct? Without staff, you can't generate sales. Even if you're the only staffer, you still have to pay you, so to speak. You need the lights on. You can't have customers coming in a dark room to buy stuff, correct? You need air condition working. These are expenses to BPL. In other words, expenses are whatever we spend to generate revenue. To make money, you have to,
Spend money.
Spend money.
and that spend money is called expenses. That's the simplest way I can put it. If you need it any simpler, I can only repeat it. Assets, on the other hand, is what the company owns. It's different from expenses. All right. Assets are what the company owns in order to generate sales as well. Okay. So, for example, and to invest and to make investments in the company. For example, if you make shoes, what asset do you need to buy in order to make shoes? Anyone?
Machinery.
Of course. How the hell are you gonna make shoes if you don't have the machinery? So you need to find money to buy the machinery. When you buy the machinery, that machinery is an asset because it makes the shoes that you need to sell. So assets represent anything that the company owns um, to do its business. An expense is the cost of generating revenues. That's the difference. People, students in particular, get caught on that all the time. So you may have to take a little time to learn the difference between expenses and assets, and you will be
Yes.
short order.
Oh, I know that. Taking up. I told you this last week. Yeah. Wow, Bobo. What you taking up? Accounting. Huh? Accounting.
Mute.
Are you guys hearing what I'm hearing? I'm the only one hearing this.
Yes, I'm hearing.
Hearing.
Okay. We're gonna soon hear something even more interesting than what we're hearing. Okay. All right. So those are your three categories: classification, valuation. What's the first one? Anyone?
Recognition.
Recognition. All right. Please make sure you understand those three categories and concepts because they are crucial to the accounting process. All right. And then notice we're back to ethics again. Do you have the computer associate story? Folks, do you have the computer associate story in your text?
Can you repeat it, Ms. Wilkins?
Under ethics and measurement issues, do you have the computer associate story? It's right under the classification, ethics and measurement issues. You don't have that?
No.
What? They don't have that? What kind of
No,
BS is
after
that?
that, is another page for double entry systems.
Oh, so you don't have the ethics and measurement.
No, we don't.
Okay, it's okay. It's really just related to what we saw with Carla and Teresa. There are ethical issues in measuring the accounting issues. Remember the three measurements we talked about: recognition. What are the other two?
Valuation and classification.
Classification.
Those are the three key measurements that we use. There are more, but those are the key ones that we'll be using immediately in accounting. So please keep them close to heart. They do have ethical issues. For example, a huge company called Computer Associates. You can Google if you want. The Computer Associates violated the guidelines for recognition. You can see on my screen when it kept its books open for a few days after the end of the reporting period. That is a no-no. They wanted to do that so revenues could be counted a quarter earlier and show higher amounts, which means by doing this and keeping the books open longer than they should have been open beyond the end of the month, the company was able to prematurely report $3.3 billion in revenues, which they should not have done. You close the books at the end of the month, no matter what, and whatever it is, it is. Okay? The SEC, the Securities Commission of the United States, found out what they were doing, ordered the company to stop this practice. And notice when it stopped this practice, the stock prices fell by almost 50%, which is why they were inflating their numbers to deceive shareholders. See my point? You may not understand everything, but it's information you need to hear about at least early. Okay? The point we're making here is that unethical practices in accounting, like anything else, will lead to problems and oftentimes destruction. The same thing happened with Enron. If you never heard about them, Enron was involved in all kinds of garbage. Enron violated the guidelines in accounting for valuation when it valued assets to related companies at far more than their actual value. Imagine that. They said that one of their subsidiary companies had assets totaling 10 million. When they found out the assets were only totaling 1 million. So they were inflating the value of their assets so the balance sheet can look better than it should have looked. These things are outright violations of these three measurements. Okay? And they should not happen. Okay? You guys will not get into this stuff because, first of all, you're just learning this stuff. And secondly, when you do learn some of these things and you see any of these violations, you will not do them because they are wrong and they can get you into big trouble. But strangely enough, even though people can get into trouble, professionals of all kinds, we still get into trouble. Like, don't do that. Okay, I swear. And when we see money around and opportunity around to get some stuff, we go, oh, the hell with my principles. The hell with my principles. I don't care about gap anymore. And their stinking measurements. I'm doing what I'm doing. But we are not to do that. All right. So we're down to the double entry system of bookkeeping. Do I need to say what that is again? What is the double entry, anybody? Anybody, what is
It's
the
the
double entry?
principle that each entry has two sides or needs to be inputted in the statements in two ways, or it affects the statement two ways.
Absolutely. Every economic event or transaction has two sides. All right. For sure. In the double entry system, each transaction must be recorded with at least one debit and one credit so that they balance. And the total debits must be equal to the total credits. It's a rule. The sooner you get it in your soul, the easier life will be going forward in accounting. If it takes you a while to get it, you'll be fighting for a little while until you get it. Very fundamental. Every single transaction that's recorded in accounting must be recorded under the double entry system. Okay? Accounts represents the basic storage units, we call it, for accounting. It's a fancy name for a T account where we record our debits and credits. You'll see them soon enough. They're often referred to as T accounts. Do you see that in your text, the T account?
No, we have chart of accounts.
Yes, my foot. That's in here too, but how the heck you got the charter accounts before T? You don't see T accounts anywhere in your chapter? How could
It's
be?
under the same.
It's
On the next
44.
Page
the
44.
next page.
Yeah, so I'm
Yeah.
looking at, but you're looking at page 44. So I don't know, you guys will be looking left and right, but this is how you'll be following it. It's the same stuff, okay? You're on page 44, that's where your T accounts are. So now you see the T accounts.
Yes.
Okay, so as you can see, why do we call it a T account?
Because it's shaped like a T.
Yeah, it's shaped like a T. On the left-hand side are the, on the right-hand
Debit.
side, credit. Now, any diligent reader of the chapter wouldn't need anyone to say that, because once you read everything, you see it's clear as sin. I just kind of throw it out there to remind you. Okay. So that's your T account. Debits are always on the left, credits are always on the right. Can you put debits to the right sometimes in accounting?
No.
No. Remember, I already said the rule is
The
debit
rule.
always. See the rules again. You could put it, but you would be violating the rules and you'll mess everything up big time. And you won't have that job or that position too long if you decide to violate the rules. See my point? Okay. So debits are always to the left, credits are always to the right, and the title or name of the account is always where?
At the top.
Absolutely. All right, so we could move now. So now we have our T account. What's the name of this account? Whatever page it's on, what's the name of this account?
Cash.
The cash account. Notice all the debits are to the left, totaling
103.
103,000.
Yes.
At least
Yeah.
we have something in common now. The numbers are the same. All right, 103,000 of the total debits. Total credits?
71,600.
71,600.
Yes. And those of you who've been reading diligently, you'll see that the debits represent cash receipts coming in, and the credits represent what?
Cash going out.
Cash going out. Yes. If you didn't read that, you'll be stuck. Say, what is it? Why does like that? Don't take any shortcuts. I am going to mention some things in the lecture, but that's no substitute for your reading. None. Okay? So you pick up on these little things, details that I'm talking about, and you can then put them in context, because whenever I say them, you've seen it, you've read it, you understand it. And if you don't, that should prompt you to check in and say, Mr. Wilkinson, I have been reading this particular page and I have no idea what an account balance is. See? However, in this example, the account balance is what?
31,400.
Yes, and how did we get that?
That's the difference between the debits and the total debits and total credit.
Correct. Or in other words, the difference between what was received in cash and what was paid out in cash. So how much cash do you have left in your account?
31,400.
Okay, just like your checkbook, yes? The only thing is your checkbook is a credit side because it's money in the bank. For the company, cash is a debit because it's an asset. Okay. All right. Remember, stop me anytime if something doesn't, like, it's a debit, or the hell is it a debit, or whatever it is. All right. Rules of double entry. Man, we know what double entry is, and we also know what this equation is, don't we?
Yes.
Okay. Yeah, notice how I'm just kind of cruising right down, because now I'm taking some things for granted. That's why I spend a little extra time on the fundamentals, so that when I get to the certain things, I don't have to say, the accounting equation is again, because now we are experts in certain areas, like the accounting equation, like the double entry system of bookkeeping. See? So I can just cruise right along now until we get to the three components of the three elements of the accounting equation. Notice it begins with assets. For assets, a debit does what to an asset?
Increase.
And a credit?
Decrease.
For liabilities, a debit does what?
Decrease.
Credit does what?
Increase.
Increase.
And for equity, a debit does what?
Decrease.
Decrease.
It does what?
Increase.
All I could say is learn it by heart until you learn it well enough to not have to know it by heart. If you do not learn them by heart, later on, some of these account balances are going to baffle you. That don't mean you still can't ask about it, certainly anytime. Okay? It'd be like hell to come to a class and not be able to ask about anything anytime. Like imagine if you ask me a question, I'm like, look, class, I'm sick and tired of answering your questions. That would be weird. Okay? It certainly won't happen in my class. So please. All right. So learn those activities by heart. For those three elements of the accounting equation, they will become absolutely important later on. All right. And notice you are given some more narrative that the debit increases assets, and same thing we just saw. It's just everything in words. Read those words. Okay. So, because the more you read them, the more you will understand this information. Does your text have study notes from time to time on the left-hand side as you read?
Yes, it does.
Please
Yes.
do not ignore them like I'm tired reading anyway, I'm not reading that. Please read the study notes. They tell you little valuable snippets about what you're reading that can help with your understanding when your lecture is not available. Okay, so please read them. All right. So now notice we have taken the accounting equation down now and expanded it. So all of a sudden, assets are still assets, liabilities are still liabilities in the equation, but now we expand the owner's equity. So it's part of it. You see that?
Yes.
Yeah. All right. So the owner's equity, it's still owner's equity, just has some subcategories that make up owner's equity. That's all. It's not a big problem. All we're learning now is that owner's equity have certain subcategories that result in the final owner's equity figure. All right. So under owner's equity, we have the owner's capital, which is similar to shareholders' equity. And then we have the owner's withdrawal, which is subtracted from capital, plus revenues that are added to capital, minus expenses, which is subtracted from capital. In other words, in any given month or year, whatever the owner's capital is, withdrawals reduce that capital. What are withdrawals? A withdrawal is not an expense. An expense is what you pay for doing business. A withdrawal occurs like when you have your own business and you say, I run out of money. I need to take some money out of my company because I want to go to Grand Bahama again to visit my family, or Vegas to gamble again because you are a gambling addict or whatever. So you go into your company's bank account, which you shouldn't do. I mean, you could do it and take out some money. You withdraw whatever you feel like because that's your company. That withdrawal reduces your original investment because now if you invested 50,000 in the company and you withdraw 10, your investment goes from 50,000 to 40,000. So you don't really want to withdraw from your company because you need that money in your company for the company to do business. You keep withdrawing, so your company won't have any money to do business and pay its bills. Does everybody see that? Even though you're entitled to withdrawal, is not a good practice, right? Because withdrawals reduce your investment or the owner's capital. Revenues, of course, sales would increase it, of course, and expenses would decrease it. Okay? Now, for some of you, it'll take a little while to connect the dots. That's why we try to make it as simple as possible by starting with owner's equity minus, plus, minus, so that you start there. All right. But this is not the last of the subcategories of owner's equity. You'll see it later and understand it better. Okay. So if we expand owner's equity to include those 4 areas, then we can drop down with our debits and credits again and look at our expanded accounting equation. All right. Let's go back to assets again. A debit does what to an asset?
Increase.
And a credit?
Decrease.
So whenever you see an asset account, and you see a debit, you know we're increasing that account. Or if I say debit cash, what am I saying? We're increasing cash. Debit accounts receivable, what am I saying? We're increasing accounts receivable. Any credits, we'll be reducing those accounts. It's the language of accounting, you just have to learn it. There's no magic formula. Liabilities, what do debits do to liabilities?
Increases.
Yeah, and credits?
Increase,
Yep. Is owner's equity debits?
decrease,
Decrease, credits?
increase,
Increase. Withdrawal, debit?
withdrawal, debit, increase.
Yeah, every time you take money out of the company, you're increasing the amount you took out of the company. That's what that means. All right, credits?
Decrease,
And how do you decrease withdrawals? You put the money back. Most people who own companies, they don't put it back. That's the problem. And then when they run short to pay bills, they say, where's the money? They forgot they took it out because they didn't even tell the accountant they took it out. The accountant is not aware they took it out. The accountant didn't pick it up, they took it out. But whenever you take it out, doesn't matter if you account for it or not, you should. But if you don't, still money out the bank. Okay? That should be paid back, which many owners don't do. This is my company, I'm not paying it bloody back. So they just reduce the investment. And so the company is short that amount of money to do its business. Not a good thing to do. Okay? Of course, many business owners don't listen. They do what they feel like doing anyway. The hell what you say, Mr. Accountant. It's my company, bastard. Just do what I pay you to and shut up. I'll do what I feel like doing. All right. What about revenues, debits?
Decrease.
Credits?
Decrease, increase,
And expenses, debits?
increase,
Credits?
decrease.
Indeed. All I can say is you have to learn it by heart. Sing it in the shower, while you're cleaning up, sing it, learn it, whatever you need to do. And then the rest will come in time through practice. All right. What is the normal balance in accounting? Did anybody understand what the normal balance is? Say it again.
It's the side that increases the account.
Yeah, it's the normal balance is the side that increases the account of the side with the higher balance. After you take one from the other, the side that has the higher balance, that would become the normal balance. Okay. So by way of an explanation, what do you think would generally always be the normal balance for cash? Debit or credit?
Debit.
Debit, of course. If you ever see the cash account with a credit balance, it's overdrawn. That means you spend more than you have because the credit is not the normal balance. You follow? So if I'm an auditor and I walk in and I pick up the trial balance, I see $50 million in the credit side in cash. Even before I do anything else, it's please, where the bank reconciliations, stop every bloody thing. What beyond 50 million? My point? Because I haven't even done any work yet. But I could tell there's a problem just from looking at the normal balance. Does everybody follow that?
Repeat that again, please.
The normal balance for cash should be a debit balance. You follow?
Okay.
In other words, in the example we did earlier, further up, what's the balance in cash after we paid 71,600?
31,400.
And we said that the normal balance is always the one that has the higher balance, right? So we had more money coming in than we had going out, correct?
Yes.
So just like a checkbook at home, the same thing. So that means if you spend less than what you had, then your normal balance would be what here? A debit, because you still have money left. However, if you spend more than you have, let's say you spend more than 103,000, then your balance would not be normal. You would have a credit balance because you spend more than 103, so your balance would be on the credit side. Does everybody see that? Now is a good time if you don't see it. All right. Okay. So these normal balances, you just have to learn them, whatever the higher side is, and you'll see from practice how it works. Whatever the higher side is that increases the account, that would normally be the debit or credit balance. But you'll see a little later how that works. Just introducing you to it, but practice it for the moment. Sing the song. Assets are always debit. Uh, Liabilities are always credit. Equity is always credit. Um, Debits increase assets, credits decrease assets. Debits decrease liabilities, credits decrease liabilities. Debits decrease revenue, credits increase. Like that, you start singing it and then you add music to it and stuff like that until you finally get it. Okay? All right. The equity account increases and decreases in normal balances. Again, the normal balance for an asset is what? Anybody? What's the normal balance for an asset?
A debit?
A debit. Are you guys seeing in your text or on my screen what I'm looking at?
Yes, we are.
Yes, the normal balance for an asset is a debit. Again, we're just showing you different ways to help you learn and remember these normal balances. Okay? So don't panic with all the green and X's. All this, these are just different ways to show you the concept of normal balances and increase and decreases so you can practice them differently and get comfortable with them. Okay? What increases an asset? A debit or credit?
Debit?
Yes. What increases a liability?
Credit?
What is the normal balance for liability?
Credit?
Good. What increases owner's equity?
A credit?
What's the normal balance?
A credit?
What increases withdrawals?
A debit?
What's the balance?
A debit.
What increases revenues?
Credit?
A credit.
What's the normal balance?
Credit?
Credit.
What's the normal balance for expenses?
Debit?
Debit.
What increases expenses?
Debits?
Absolutely. What can we say? Those are all kinds of different variations to get you to learn this stuff. You just have to work it. Sorry, there's no magic wand with this crazy stuff. All right. This diagram again is only to show you the connection which we saw earlier, owner's equity to owner's equity. What does withdrawals do to owner's equity? Anyone again?
Reduces it.
Of course, and revenues?
Increases it.
Doggone it, this thing is beginning to sink in. And expenses?
Reduces.
Okay. Go to the head of the class. What can I say? This stuff is finally kicking in. Do you guys have stop and apply in your text?
Yes, we do.
They're all through the chapters. Please, don't say you're tired from reading. Don't say I'm sick of reading accounting now, I'm not doing these. Stop and apply. If you want to be really good at understanding the core concepts of what you're reading, please stop and apply. Read it, look at the question that they ask, look at the answers they give, and make sure you understand the answers that are given. That's how you learn this stuff better. If you say, man, I'm not reading it, bloody stop and apply, I'm tired of reading stuff, I'm just gonna keep reading the normal stuff, you can do that. But I encourage you to stop and apply. They were even nice enough to give you the answers so you can see how it applies to for your better understanding. So go through them, make sure you understand them. Any part of a stop and apply you don't understand for some reason, make a note of it so you can raise it when we come back to class, or if you cannot wait for class day, like send me an email like, I can't wait for a bloody Saturday. I need to know now. Okay? Please, it's very important. All right. And then Now we get into the actual business transaction analysis, which is really the key problem. Does everybody hear what I hear? Like somebody's cutting something.
Yes, we do.
Yes, we do.
Okie dokie. Ha. All right. So now we get into the actual business transaction analysis. And the reason why we call it analysis, because you have to break down every transaction and say, what type of transaction is this? Okay, state the transaction, analyze it, like determine which accounts are affected. What type of transaction is this? What do we debit? What do we credit? Which accounts are debited and credited? Are we applying the rules of double entry to each transaction? Okay, and then putting the transaction in we call general journal form, which you'll see. And then all of those four steps constitute the analysis, and each one has to be done each time. Now, as we get better, we learn we don't have to refer to the steps because we know them. But that's what's involved, each of those four steps. And if we miss any step, we're in trouble somewhere. Okay? Notice the initial recording of every transaction, how it looks. You see that? We have a date in the journal. We have a debit with a name, a credit with a name, and then we have an account that we debit and account that we credit. That's the foundation of accounting. If you violate any of these things, you're going to be in trouble. All right. We do have a number 5 called a narrative, which goes at the bottom of each transaction in the journal, which tells anybody who picks it up what the transaction represents. It's called an audit trail. Okay. So it's very important. And so now we begin our discussions with how to analyze different types of investments for a business entity. Okay. And what's the name of your business entity that you're looking at on July 1st? Anyone? What's the name of your business entity?
I think this one is saying Joan Blue.
Who?
This has Blue Design Studio.
Blue Designs.
Yeah, it's on page 48.
Yes, yes, J Blue. It's the same figure.
You mean 40,000?
Yeah.
What's the name of the owner?
J Blue Capital.
J Blue Capital.
That's interesting. So we did change the owner's name from Joan to J Blue, but the numbers are the same, yes?
Yes.
I don't know, they must have been bored trying to add a little variety to the matter. Okay, so I'm saying Joan, you're saying Joe Blow. That's good because it goes to show you that doesn't matter what the name is, the principles remain the same. So how much does the owner invest in this company?
40,000.
40,000. Now notice I'm not going like line for line analysis, the owner, because I'm assuming that you've read this, but I'm also saying in the 4 steps that we mentioned above, we mentioned each of those things have to be a part of this transaction. So now we can get right into the analysis. We are told that the owner invests $40,000 in the company. All right. And then, so when we look at the analysis, what happens? We are told that the business, that what happens? The investment in the business increases. Do you see that? Okay.
Yeah.
And the cash in the business increases as well. So in this investment transaction, the bookkeeper has to do 2 things: account for the increase in cash that was put into the new business, and also account for the increase in owner's equity. Do you see that, folks?
Yeah.
Yeah, see, it's critical to make sure you analyze and classify the accounts properly before you put them in the journal and before you post them to the ledger. In this case, the ledger is first and the journal is second. So I don't know why they do it that way. Unfortunately, the journal should be first with the ledger because that's how it works in practice. So for our purposes, we'll do the journal entry first, we look at it, and then we look at the posting on top. not the other way around. All right. So in the journal entry on July 1, notice the date is there. What do we debit and for how much?
Cash,
For how much?
40,000.
And what do we credit and how much?
Capital, 40,000.
Just capital? Oh, they have the owner's name?
J Miller.
J Blue Capital.
Correct. There's a reason for that. For a sole proprietorship like this, when you're recording capital and establishing a capital account, it has to be called by the owner's name because it's a sole proprietorship. Okay, folks? So if it's J Blue, you have to put J Blue, comma, capital. If it's Joan Miller, you put Joan Miller or J Miller, capital. That's how precise accounting is. So there's no doubt or ambiguity about what's going on. And so anybody picking it up would not have to guess. They could see it clearly. Okay? So we debit cash, 40,000, and we credit the owner's capital for 40,000. Now we can go to the double entry application. We see we have a cash account and we have an owner's equity account. Notice sitting on top of everything is the accounting equation because everything must always what? Must always what?
Balance.
Balance, okay? Do we have any liabilities yet? No. So under liabilities in the equation, there's what? Nothing. You see that? Under assets, we have a debit to cash. And under equity, we have a credit to owner's equity or capital. Does everybody see that?
Yes.
So now the business is starting with money in the bank. The investment is made of 40,000 and we've properly accounted using the double entry system by journal entry and posting to the relevant accounts. And everything else is going to follow from there. Question?
So, Mr. Wilkinson, with all the computer, the accounting packages now computerized.
Right.
If I was doing this on the computer, would it automatically generate to do this double entry, or I would have to go do it separately?
It will automatically do it. Once you type in the transaction, depending on the type of computer system you have, software you have, once you type in the information, the system will automatically classify it and prepare the journal entry and post it. Now, some software, many software issues have, you have to actually put in the journal entry. So you'd have to put the debit and credit. All right. Once you put it in correctly, then the posting will be done automatically and the financial statements will be done automatically from that information. Okay. So the most you may have to do is actually prepare the journal entry and the system will do the rest. Some software packages have you just type in a certain amount of information about the economic activity and the system itself will classify it. But generally, you have to know enough about the transaction to analyze it properly. Because remember, computer is fast and accurate, but it's pretty stupid otherwise. It only does what it to do. Okay? So you have to make sure you put in the correct information at the beginning. Because remember, garbage in,
garbage out.
Yes, you can't blame the computer. It's only going to compute what you put in. So once you put that journal entry correctly, the computer will do everything else for you. Okay? Sure. All right, let's do one more transaction and then we'll break for today. On July 2nd, what happened? Sorry? What happened on July 2nd?
She ordered supplies.
How much?
5,200.
Notice we are told that something happened, but it's not an economic event for a business transaction for accountants. You see that?
Yeah.
Please read the comments in each one. Remember I said no shortcuts. If you take shortcuts, the only person you're going to hurt at the end is you. All right? Notice the comment, when an economic event does not constitute a business transaction, no entry is made. In this case, there is no confirmation that the supplies have been shipped or that the title has passed to the owner who ordered the supplies. Until you get your stuff in hand and take ownership, you have nothing to record. You do have a business event, but you have nothing to record. You follow?
Yes.
When you take possession of the goods, then you can take that bloody invoice and record it, but not until you get possession. Because if you record it before you get possession and you never get them, then you have a problem, Houston. You have something on your books for something you have not gotten, or now you have to go back and reverse it if anybody remembers. And if somebody doesn't remember to reverse it because you didn't get it, then your accounts are going to be overstated and incorrect. Correct?
Yeah.
Mm.
So, Mr. Wilkinson, she ordered the supplies. What if she had paid for the supplies?
If you pay, then you can record. That's evidence of a transaction. Now, if you wish to pay before you get them, and sometimes you have to pay before you get them, correct?
Yes.
Once you pay, then you have a business accounting transaction for recording because you did something. You paid the company's money. So money is going out, you have to record that, even though you don't have the goods yet.
Okay.
Okay, good question, good point. But if you haven't paid and you haven't received the goods, you only ordered them, that's fine, but you have nothing to record yet. Be careful with that. Okay? Don't record for what you might happen. Accountants don't record for what might happen. We only record what actually happened. We don't deal in the might, may, could be sort of according to economic analysis. We don't operate on that basis at all. Let the economists and the other people speculate. Accountants do not speculate in recording. When it is done, that's when we want to see you. As long as you're speculating and other, not please keep passing the door. Now, when something happens, please come to the accounting department because we only deal in what actually happened, something that is substantive. Okay? All right. So we're going to stop there today. So next week, we're going to have a harrowing time because next week we have to finish our analysis in chapter 2 for all of them. And then we're going to go right into chapter 3. So please, if you haven't read chapter 2 yet, you now have chapter 2 and chapter 3 to read. If you haven't read chapter 1 yet, you now have 2 and 3 to read by next week. And remember, time flies. By next week, we'll be into week number 4 with all kinds of information piling up. Getting ready for week number 7, which is right down the road, waiting to make us suffer. Test day. So please, if you haven't caught up on your reading yet, please do it. Start this weekend. Start reading all kinds of crap this weekend to catch up so that by next week, you've at least read this stuff. Remember, you don't have to understand every bloody thing you read. That's okay. It'll all come together as long as you stay on top of your reading. Capiche?
Yes, sir.
Comprende?
Yep.
Fantastic. You guys have a great week. If you get stuck, you know I'm available. Send me an email. I'll be happy to answer any questions. Until then, read, catch up on your reading. Do not fall behind. I know what I'm talking about. I've seen myself suffer back in the old days, waiting, procrastinating, and I've seen students suffer endlessly because of procrastination. They were busy with something else. Don't do that. It's fine to be busy with something else. Make time for your reading. That'll be to your benefit. I know I've said that a million times. I know why. All right, folks, have a great week, and I shall see you in a kick and a punch.
Yes. You too.
All right? You guys take
Yes,
care.
have a good weekend.
Yes.
When you make a payment, it's on the right side.